I found a simple, repeatable trading strategy that has helped turn losing traders into consistently profitable ones. This hasn't just worked for me, but for thousands of struggling traders who are losing thousands of dollars before learning this strategy. And the reason I'm confident teaching this is simple. This isn't theory. Real traders are using this with real money and getting consistent results. Most traders don't fail because they're not smart enough. They fail because they're overwhelmed. Too many strategies, too much noise, and no clear trading roadmap. This is the roadmap I wish I had when I first started. And it's what every trader needs from day one to become consistently profitable. Whether you're starting from absolute zero or you've been trading and feeling stuck for a while, this is a complete start to finish guide designed to take you from beginner all the way to confidently executing trades. This is a full 3-hour masterclass, and by the end of it, you should understand trading well enough that you do not need to watch 10 other videos to fill in the gaps. We'll start with the foundation most traders skip: how the markets actually move, how to think in probabilities, how trading risk really works, and what consistently becoming profitable truly means. Then I'll show you how to read charts step by step, from the basics all the way to identifying high probability areas in the market that you can make money from. From there, I'll break down the exact strategy that has helped so many struggling traders finally become consistently profitable. And I'll walk through real examples, real trades to show you exactly how to execute it. This isn't a simple overview or a highlight reel. It's a complete trading system taught from scratch with nothing skipped. And again, this works. Traders are using this already to consistently make money. If you're willing to actually put in the time to watch this video, this will probably be the only video you ever need to watch. So let's start at the beginning so you can build a foundation for trading success. So let's talk about the simples of how the markets work. Over here, I have a chart open. Let's not worry about anything else other than just how and why the market goes up and down. This is a representation of the mass psychology and people trading this market. It doesn't matter what you're looking at, but that is what price of these up and down movements represents, of buyers and sellers coming in, of either traders and investors like you and me, or big banks, big hedge funds, algorithms, everyone that is participating in this market. And essentially what causes the price to move down or up over time is the imbalances between buyers and sellers. What caused the market to move down right here was there was a lot more people wanting to sell than buy. And this imbalance pushes the market down. And then eventually it got to a point where that imbalance was filled, and then it flipped and a lot more people started to want to buy. There's a lot more demand in the market. And so that's what pushed this up over time. And these little imbalances, you can see if you zoom more into the chart, will go up and down over time in the smaller points in the market. And this is what volatility is called, these up and down movements. These create, on a smaller time frame, trading opportunities that we'll talk about later. Now, how you make money trading is, let's say this is a stock chart of, let's say, Apple. And down here, it's trading at $100. If we buy 10 shares at $100 and it moves up here to, let's say, 105, and we sell those 10 shares, the amount of profit we'll make is this difference of $5 that it moved up times the 10 shares we purchased. So we will make $50 over that time frame trading. And so this is the whole idea of how you make money trading, is you buy at a certain price and then sell at another price to make that difference. And so this is actually a chart of the S&P 500 futures. And normally over a year of long-term investing, you can expect to get, let's say, 10% return on average long-term investing in the S&P 500. This is your basic safe investment. And so if you took $100, you would get $110 after 1 year. But when it comes to trading, you can take something like that $100 and you can turn it into $300 in a matter of days or weeks or even minutes, depending on your strategy and your time frame that you're trading. But unlike long-term investing, is you can lose all of this $100 in that same time frame as well, compared to if you invest in the overall S&P 500 future stock market. Well, for that $100 to go to zero, the stock market has to go to zero, and you're probably gonna have bigger issues than losing your $100 if that happens. So there's a lot more risk involved, but the reward is higher if, again, you can master some key steps. And so here's a quick example of a trade I took on a 1 minute chart. So it's a lot faster paced. I saw essentially a couple of key factors of why I thought it was important to buy down here, and then I thought the market would reverse up. And then I bet that it would go up, risking $1,700. And then if it goes up here, I make, about $5,000. I think on this trade, I made roughly $4,500 over about 15 minutes. So that's really fast paced. Again, there's trades where I lose essentially that $1,700 in 15 minutes. So that risk is there as well, but the math and strategy over time play out in my favor. And we'll talk about how that works in a minute. But you're not gonna be making that much money right away. It took me years to scale my account to be risking that much at once. When I first started, I was risking $50 a trade. And over time, I scaled and got bigger and bigger. And so what the trading journey looks like as you start out, you're probably gonna be either losing money slowly over time, or you're gonna be break even and really not making that much, because it's just gonna take time to get used to what you're doing, how trading works, and mastering your strategy and your emotions and psychology that we'll talk about in a second that really make or break your trading. And then eventually what will happen is you will start to find some consistent profitability when you nail down a trading strategy. But because you're trading small size, it's not gonna be that much right away. But don't focus on the money initially. That is what ruins traders. Even me recently, when I sized up to this current size I'm at, I went on an emotional roller coaster spiral and lost a lot of money because I started focusing on the money way too much. I started thinking, holy cow, I can now make $5,000 in 15 minutes. And that really messed with my ability to consistently execute the strategy. But eventually, as you size up, that $10 will start to become $50, $100, $200. And then your equity curve and how much you're making will go parabolic in the essential. It'll be an exponential graph because you're not making $10 anymore. You're now making $100. And then you're making $1,000 per trade. And so that'll slowly happen over time, years potentially, but that's where the real money comes trading. Now, when it comes to what you should actually trade, you can choose anything that you want. But over my years, I trade stocks, options, crypto, Forex, and futures. And what I've realized over time is futures is the best thing to trade if you want to start out with a small account, but still be able to get a lot of leverage. Trading the S&P 500 futures has something like 450 to 500 times leverage, which is insane. But essentially what it allows you to do is participate in trading where you only need $50 in your account to get started. I would suggest having a little bit more than that, maybe something like 500, because if you lose one trade, you're gonna have to redeposit money, but you can essentially use this $50 to enter in a trade and even be risking less than that, maybe even $20. We'll talk about, and I'll show you some trade examples in a minute here. But what it allows you to do is able to say, hey, I wanna risk $20 in this trade, and I will try and triple that and make $60. And so you can start out really small, because again, going back to this journey is, in the beginning, you need to just be focusing on learning, because you're gonna lose money most likely, or you're gonna just be break even for a while. You may have streaks where maybe you make money for a week or two, but then you'll give it back up because the market is really, really hard to trade over a long period of time. There's different market cycles that cause you to have to adjust. And if you don't know how to do it because you're not experienced, you'll lose money. Now, when it comes to a trading platform and tools to use, I highly recommend checking out this platform. It's what I've used for over 5 years now for trading futures. It's called NinjaTrader. I'll leave a link for it in the description below, or you can use this QR code. And it's super, super powerful for trading futures. You can easily draw and use any basic charting software you need, but the ability to be able to manage trades super easily by moving up your stop loss, or you're moving around your targets of profit just with a click of a button and a chart, and as well a tool that I have created for it where I can easily have the system tell me how many contracts I need to trade. We'll talk about it in a minute, to risk a certain target and continuously stick to that proper risk is super, super powerful. And the biggest thing is what this will give you access to is your candlestick charts, which are super important for really deep diving into what is going on with the markets and reading the price movements that will really, really help you in the long term.
Now, prior to candlestick charts, we had just simple line charts that is essentially just connecting 2 dots or more. Now, instead, candlesticks give us 4 points of data, and you can see comparing these 2 charts, there's a lot of data down here that you're missing in the line chart. That's why candlestick charts are so important. Candlestick charts give you 4 points of data. They give you the closing price, the opening price, and the extreme low and high of that candlestick. A green candlestick signifies that the price went up over the candlestick, and a red signifies that it went down. And then what you have outside of the body of the candlestick is you have what's called a wick. And essentially this just shows you where the price moved to the extreme high before it ended up closing or opening at the price the candlestick closed at. And then candlesticks can also represent different time periods. One candlestick can be changed to represent any amount of time or volume, but the idea is that it represents a certain amount of data. A lot of the time, and most commonly, it's a time-based chart where one candlestick can represent 1 minute, 10 minutes, 30 minutes, an hour, a day, a week. And what this allows you to do is create all these different patterns in those different time frames. So even if you see a pattern on a 1 minute chart, it may play out a specific move on a 1 minute chart, but there could be a completely different pattern on a 30-minute chart. But all the candlestick patterns and everything that we're going to go over can be used on any market or time frame, because what you're doing is you're reading the candlesticks, and candlesticks represent the price movement of that asset you're looking at, and it's essentially the raw data of where the buyers and sellers are. And so no matter what you're trading, it's representing that raw data, and all these patterns are common indicators of what that raw data is really telling you could happen in the market. Now, most traders know what candlesticks are, but almost none of them know how to actually use them correctly. And that's why I'm building up to the tool that I use to confirm what really makes a candlestick pattern a signal and not just noise to fake you out. Now, make sure to remember these 4 key points in the candlestick, because one of the tools that I'm going to show you later is entirely based on this data, and it's extremely powerful for helping you confirm candlestick entries. Now let's go over some candlestick anatomy. The first off being big versus small bodies and what this means. A big body represents dominance from either the buyers or sellers. This green candlestick right here, opening here, moving all the way up here and closing, shows a lot of buying pressure, versus something smaller like this, where the sellers, it opens up here, moves down and closes here, is small, representing not that much movement from the sellers. This is a trade right here where I made over $2,000. And yeah, this candlestick right here was a really big clue to jump in on the trade, but wasn't the overall reason of why I took this trade. The real confirmation came from something else, something that I'll show you later that helps me confirm whether a candlestick pattern is worth entering in or not. The big candlesticks matter, but only when they align with the right signals. Now, the second most important structure you'll see is candlesticks with large wicks. This candlestick right here is showing you a potential for a reversal because the price of this candlestick opened up here, pushed up higher, and then sold off and closed a tiny bit above where it was. But essentially what this candlestick is telling you is that this overall price was rejected. And so it could signal a potential for a reversal. Same thing with this candlestick. The only difference is a slight difference in the open price of the candlestick and the close price. It's just flipped. And then this candlestick pattern right here is the same thing, but in reverse, where the price opened up here, pushed a little higher, sold off hard, but then that hard sell-off there was reversed and it closed somewhere there. Again, this is showing you a potential for a reversal to come in the following candlesticks. This is why knowing that data versus just a line chart is extremely important. Now, these big wicks are critical for entering into potential trades. This trade right here, this big reversal candlestick with a huge wick, was the final confirmation to jump on this trade that made over $1,000 in just a few minutes, but only when they appear in the right context. In a minute, I'm going to show you how to tell when these big reversal wicked candlesticks are actually important and when they're just making noise trying to trap you. Now, the last one of these is when there is a small body and equal wicks on above or below the body of the candlestick. What these do is they show classic indecision. And the whole reason of this is because for either of these three candlestick patterns, the price essentially opened up somewhere in the middle of the candlestick, pushed one direction, reversed the other direction, and then reversed again, closing near the middle of the candlestick. With this one right here, it specifically opened and closed at the exact same price, showing no movement. But it's really key to know that because what this does is it shows indecision, and these are called dojis. But here's the problem. Dojis constantly fake people out or just get them in bad trades. So in a minute, I'll show you how to read them correctly and use them to your advantage. But first, we need to talk about multi-candlestick patterns. Now let's jump into the top 6 candlestick patterns I've used over the years. These are common candlestick patterns that you will see that based on their structure and the market psychology of what the data is showing you, commonly will play out in a specific manner. Now, the first one of these candlestick patterns is called the engulfing candlestick pattern. It's just a 2 candlestick pattern, but what it signifies is that it's a reversal pattern where the chart is coming down, and if you see this pattern, it will signify that it's likely that the price reverses to the upside. The idea of how this works is you have a bearish candlestick that is engulfed by a bullish candlestick right after it, where the open of this candlestick is lower than the low of the previous candlestick and the close of it is higher than the high of the bearish candlestick. The whole idea is it is a massive reversal happening where it completely blows out the previous candlestick. And this can happen on the flip side for the bearish version too, where a smaller bullish candlestick is engulfed by a big bearish candlestick. And again, the idea is that it's a reversal candlestick and likely the market is going to reverse after this. And this is a great confirmation for an entry, just like the trades I showed earlier. But again, you don't want to just blindly be using it by itself. The next one of these patterns is called a pin bar candlestick. This is where the importance of wicks comes into play. What this can help us do is it's another reversal candlestick pattern, but the idea is that you have a big bullish candlestick followed by what's called this reversal candlestick. This large wick is showing us that the price tried to continue higher and was rejected. It's showing you a flip in the momentum of the market that this is representing. The price was previously moving higher, and a topping pattern is going to flip the price of the market. And this candlestick here is showing that. And followed by it to complete this pattern is a nice bearish reversal candlestick. After this, the idea is that this is going to reverse lower, and it's a confirmation that you can use to enter into a trade. Same thing goes for the bullish version, where it's coming down, reversing in a big way, and it's indicating that the market could continue higher, reversing that trend that it was in. This is how you can start to read the market like a book. You can start to use these patterns and slowly build upon them, connecting them so you can eventually read a whole stock chart clearly. This next candlestick pattern is called a 3-line strike pattern. What it's showing you is there is a clean, methodical uptrend in the market, and then it is broken and reversed very rapidly by this huge engulfing candlestick that engulfs multiple of the candlesticks before it. It shows you a massive switch in momentum and a massive increase in momentum in the other direction. And so how you can use this is, again, bullish or bearish side, is that the market is switching from a slow methodical move lower to a rapid move higher. Buyers are really stepping in, wanting to buy at this level, which is likely to continue to push the market higher after this pattern. Again, these patterns are super powerful, but you have to stack them with other indicators. Now that we can start to get into some larger patterns, and a flag pattern is a key pattern that will help us understand how to read dojis. And so how this pattern works is it's a continuation pattern. The idea is the market moves up and goes sideways. It essentially creates a flag. The idea with this is the market's had a really strong move higher, and it's now just taking a breather. It's coming to a point where it just needs to catch its breath. It's a little overextended, and this pattern often signifies a continuation, that it could continue higher, that this momentum that it had before is just taking a pause, and it's going to come back in and push the market higher. But what will often happen is you'll start to see dojis here when it flags out. And dojis are okay if there's a couple of them, but once there becomes too many, you can start to get trapped. If we flip over to the bearish version here, it's the same thing to the flip side, where we have a strong momentum to the downside, but then it starts to go sideways. And the key to knowing if this is really going to continue, or it could do what I call a failed breakout, where it attempts to break lower and the market actually reverses, trapping people and making this pattern cause a false signal, is when you start to get a lot of dojis stacking up. When you start to see the market just sit there for too long, that's when the momentum has really just dried up and it's not taking a brief break. The idea with this pattern is it has a large momentum move and it just takes a quick break before it continues higher. If it starts to take too long of a break like this, that's when you want to stay out. That's when the dojis can really start to give you some insight that there is too much indecision in the market, and it's likely to not have a clear move in either direction that is easy to trade, and you should stay out of the market. I used to fall for this all the time myself. This pattern right here looks really clean, right? But this can easily turn into what I call a failed breakout, where the market pushes lower and then immediately flips on you, reversing higher. There's one key missing step that is really good to know to tell the difference between if it's actually going to break out or do a fake out. And we're almost to where we can talk about that, but I want to first talk about a few big picture candlestick patterns that are really going to tie this all together for you. The first one of those is a pullback pattern. This is a super simple market structure pattern, but it'll start to connect some of these dots for you. The whole idea with this is, here's the bearish version, which means the market's going to reverse, is the market's coming up in a nice solid trend higher. It pulls back and then it pushes one more time up. But then what happens is you'll notice we get an engulfing candlestick pattern right here. And what that signals is it's putting in a lower high right here. This swing, if you kind of just think about it like a line chart now, is the market made a high here, pulled back, made one more high here, and now is pushing lower. That high is lower than this one. And in the big picture structure idea of the market, that is a big reversal signal. If you couple it with this engulfing candlestick pattern, this starts to become a powerful signal. As soon as this engulfing candlestick pattern here is formed, you can use that as a confirmation to enter in on a trade with the idea that the market is going to push lower based off of that. Same thing goes for the bullish side. But you can see on the flip side, same thing. But you could have a different candlestick pattern, making this, you can even call it a double bottom. This is how you start to look at candlesticks and create larger picture structures in the market that can signal key areas that you want to pay attention to. So you can start to see this pattern and the flag pattern are very similar in a lot of ways. How do you know when a pattern is going to either continue or when it's going to fake you out in the opposite direction in reverse? Which is why in a minute we're going to go over how do you know when it's actually the right time to jump into a trade versus when it's important to stay out so you don't actually get trapped and lose money. Now the last one of these is called the head and shoulders pattern. It's a big key reversal pattern, but again, it's really powerful when you couple it with the indicators that really confirm whether an area is worth taking a trade or not. The whole idea of how this works is it's looking at the big picture structure of the market. It's essentially looking at the swings of the market where it's making in an uptrend, it's making higher highs and higher lows consistently, and then all of a sudden it switches to making lower lows and then lower highs. What you'll start to notice about these patterns is that they're very simple. You do not need complex patterns to understand what the market is doing. And keys with this head and shoulders pattern is on the bullish side where this is going to signal, we're going to make a reversal to the upside. This key is you want this final extreme low that it makes to be strong and then it to reverse quickly. Essentially, it's showing you the market got overextended, accelerated to this side, and then buyers came in a big way and pushed it to the upside. This final pullback here, and really adding this pullback pattern that we talked about earlier, essentially what it's doing is it's showing you, it's giving you the confirmation of, okay, is this gonna just continue lower? Because, well, it could just continue making lower lows and lower highs here, but once it creates this bottom here and really starts to form this candle and this candle, that's when you can confidently say that, okay, it's starting to shift. And that's how you use these patterns to understand what the market is gonna do. And so when it comes to trading, a lot of times you start out thinking that I need, 10 different indicators on my chart and all these different things that make it easy to, know what to do, because it seems like an indicator can just tell you what to do. But at the end of the day, if you learn to just do some of these basic chart analysis things, you will drastically improve your trading. And one of those is just learning to look at the major swing highs and swing lows of a market. It will drastically improve your understanding of the direction of the overall trend. And when it comes to actually entering in trades, the biggest factor I always take into consideration, no matter how good the more smaller patterns look, is the overall big picture of what the market is doing, because that is going to rule your trade no matter what. It doesn't matter how good a support level looks or a trend line looks. If it's coming to a major area where, and your big picture analysis of a trend is that it's overextended and it needs to slow down, well, if you, jump in short right here and you weren't looking at just that big picture, you're gonna be losing a lot more trades than you want. And so the basics of, downtrends and uptrends are made by the market making lower lows and lower highs, where just the swings are getting lower and lower. An uptrend is just a flip where it's making higher highs and higher lows. And this really helps you, just this basic structure helps you stay on the right side of the market of saying, okay, well, overall, this thing is mainly making lower lows and lower highs. There can be some times where, okay, it gets a little back and forth here, where it has right here, it had actually more of a quick uptrend
before it continued its downtrend. So that could have just been a pullback in the major downtrend that was taking place. And this can also happen because what's happening is you're at a transition period where you are going from a downtrend where it's making consistent lower lows and lower highs, and then all of a sudden it starts making a higher low and then a higher high, and it shifts to an uptrend. So you're gonna have these areas, and these are really key to start to learn, is have areas where it starts to shift, and you wanna be aware of that because that's when the trend is starting to change. If you're either in a trade betting that it's gonna go down, well, that's usually a signal to get out. Or if you're looking for the market to reverse to the upside, well, you can take that into account for going long and taking a reversal trade and trying to buy the bottom of the swing. And so a super helpful thing with identifying a lot of the swings in the market, and this is just gonna take you time to understand, is going through, and you can use things like a trend line. And so how I like to draw trend lines is if I just use a quick drawing to kind of show you before we look at the charts, because no chart really looks like this. But a lot of the time what you want to do is you want to essentially just match the highs. The idea with the trend line is you're matching it to all the main swing highs that you're seeing. And then on the flip side, you can also make what's called a channel where essentially it's both, where the market doesn't do this a lot of the time, but it can sometimes make a channel where on the upside, where the pullbacks, they will respect a downtrend, and then on the swing low side is they'll also basically be respecting a downwards trending support line. And this is a downwards trending resistance line. And so what those do is those essentially make a channel, and they make it really easy to identify what the market is doing. Now, because the market is always changing, now a clear kind of one is actually on a bigger time frame right now. This is the NASDAQ futures. So how you want to draw a trend line and start one is you'll see here we're looking at the big swings here, and then it makes a high here, and then it starts to just trend lower. Now, you're not going to know these right away. It takes some time, and it usually takes at least 2 swings to be able to draw that trend line before knowing it could bounce off of it a third time. And so I like to at least wait for 2 swings to draw it off of. And so here, there's this big swing up here and this swing right here. And so for me, I would take a drawing tool and start it at the swing high here and then draw it touching this next one. And then so here you can see the market came up here and it didn't quite touch this if you put it to exactly the highs. But so that's the big thing about any tool or drawing tool you use in the market with support or resistance, trend lines, anything you use, take it with a grain of salt. You can have some flexibility in it. It's not gonna be, okay, well, it didn't touch my line exactly, so I'm not gonna, it didn't count, right? Think of it more of like a zone. This is a big thing I do, and we'll talk about it in a minute with my support or resistance levels, is I don't think of it like one line. I think of it as an area where, okay, well, the market will come up here somewhere and reverse lower. Versus this, it's a big line. I don't wait for it to come exactly up here. So if it's coming up here, I'm thinking, okay, well, it's close. And if a trade set up off of that, then I would take a trade off of it. And so once it finishes, well, then I'm going to adjust based on that, because I consider this to be a pretty clear touch and a reversal. And so going forwards, again, I would look at that and say, okay, well, extend this out and see what happens. And this is where trend lines and everything become very subjective, is you can match this either with the highs, or you can also drag it down here and say, well, there's all these bodies here. Well, if you do that, you can see that this got a lot closer here and made a lot more sense. And so that's where drawing tools can be a little tricky, or drawing trend lines can be a little tricky, is it can be very subjective, because you can see here, well, once we got down here and down here is what pretty much was touching these ones as well. And so that's kind of how trend lines work. And so that's why where drawing them, my kind of rule of thumb is take it with a grain of salt. It doesn't count as a break of the trend line if it, breaks by 1 candlestick and goes back in, or it has a wick that breaks above. A clean break of a trend line is where the candlesticks clearly break out here like this. And so kind of on the flip side, what that can look like, just to find you a quick example here, here's another just moving back in the chart a little bit. Here's kind of a trend line right here I would consider. And you can see here, it's clearly broken that. And so at that point, I would say, hey, I think that this trend is over. The potential there means that it could either go sideways or it could reverse to the upside. And so from that point, you would use whatever other factors you're using, an analysis like support zone here, I already have drawn on the chart, or just looking at the big picture, where are the big swings in the market and kind of what's been going on. So at that point, it looks like, okay, yeah, it's kind of bouncing, and I would look for, kind of a move off of that. And so when it comes to practically using trend lines, they're going to be broken pretty quickly a lot of the time. And a good example was actually this morning in gold, where on actually a 1 minute chart here, is it had a really nice bottom here and a trend line up. And so the market just followed this for a while until it eventually broke. And so you can have multiple types of trend lines where they're really sharp here and just kind of very fast paced, or like that bigger picture downtrend one they were looking at. And even gold actually has one going on right now too, is zooming out to more of a bigger picture 15-minute chart. As you can see here, it's got this, it made a larger swing high right here, kind of a double top, and then it's had two clear swings here, and then the third one I think pretty clearly bounced off of that. And so another example here is on the flip side. You can see on the bottom end, I've drawn a swing off of these two, and then there's this third one right here. And so it looks like it's clearly starting to bounce there, find some support. And so that's how you can start to use these as clearly predicting where the market could slow down and reverse. Now, one last one is, I call it a spike and channel, or a spike and trend, where a lot of times in a beginning of a move, the market right here, you can see it does a quick spike where it just moves very rapidly in one direction, and then it starts to slow down into more of a methodical trend. Now this one's still pretty tight here, but you can have it essentially on the flip side too, on an uptrend where it goes up and then it starts to go into more of a healthier trend. The market has a lot of different types of trends where, they're unhealthy moves like this, where they're likely to have a pullback or consolidation at some point, or more healthier moves where, like this, if we zoom out, where, it's slowly moving back and forth. And that's more of a range bound move. And when it comes to trading futures, I've always found it to be very important to stick to when there's more volatility in the market, because trading in, a choppy market, this is the NASDAQ yesterday on a 5-minute chart. This is the whole day of trading basically. And this is the first kind of 2 hours. And you can see it just sat here and did nothing. And so that's times where you kind of want to stay out and not watch the market too much, and save your money for a day where you have more volatility like this, where there's more moves that are more tradable. And so this is where time frames are really important to pay attention to. You can trade whatever time frame you want, but when it comes to futures, I highly recommend sticking to entering your trades on either a 1 minute chart or a 5-minute chart. And then bigger picture, you can look at, I like to look at a 15-minute chart or a 30-minute chart for kind of understanding the broader picture of what the market's doing, drawing these kind of bigger swing moves. And that really helps you understand the big picture of what's going on, because you can easily see, okay, based on just the swings of the market right here in gold, that it's pretty back and forth right now. It's kind of in this downwards tightening wedge that's going on. But just looking at this and not really analyzing it too much, you can think that, okay, well, just based on what it's been doing, it's kind of been going back and forth with some moves in between. And so when it makes this move, well, it's probably likely to move back up, because the market likes to just repeat what it's doing most of the time until obviously the trend kind of shifts. But when it's in this kind of back and forth mode, going into a larger time frame to see that and understand that is really important, because then you can go into a 1 minute like this or a 5-minute and enter your trades more accurately near the lows of that swing. And you could enter in right here betting that the market was going to go up, capture that swing, and you could get something like 4 times your risk in your profits. And so that's why timeframes are really important, and especially day trading and intraday trading, because when it comes to futures, intraday margin is very, very powerful. And the real reason why I think it's good to trade futures, if you're trying to swing trade futures, I think there's other better, safer assets to do that. But when it comes to day trading, futures are really, really powerful because of the low margin requirement that some brokers have. And so that's what I use when it comes to trading. I use a 1 minute and a 5 minute to enter, and a 15 and a 30 to analyze my charts. And that's the whole idea of technical analysis, is just using the basic structure of the market. Now, where you can get in trouble is over analyzing. And that's why I like to stick to where it's just super clear and really obvious what's going on, and staying out of insanely choppy times like this. The market, the last couple of days here, you can see these are the opening days, and then this is kind of the overnight movement. Every day here, the NASDAQ here has pretty much just done nothing. There's times in the market where you'll have movements that are just terrible for trading. Every strategy has market conditions that are crappy. My strategy is more of a reversal strategy of taking trades off of either big trend lines and looking for a move down, or off of, good support lines and looking for moves up off of those. But any time that the market is just sitting here chopping like this, and you can even go to a 1 minute chart. Today had some good movement for the first time, but if I zoom in on this day, you can see it's just back and forth. If you zoom in, it looks like maybe there's some good movement, but big picture again, there's really, really little movement to capture. Or continuation markets are terrible when the market is in more of a range bound or reversal volatile market. And so that's why it's really important for you to understand what markets are good to trade in and what aren't. And the biggest one, again, is choppy markets, and just learning to understand and read, okay, well, when is there a big movement and volatility? That's when you want to start paying attention and looking for potential trades. It doesn't have to be necessarily looking for reversals. It could be looking for continuations if you think the trend is really strong. Again, that's why you look at the big picture and say, okay, what do I think is happening? And if we look at and analyze this, well, the market was in a big downtrend, and then it started to have this support level. Well, I think when it breaks this support level, it's had all this consolidation, which is really healthy for the market. And so once it breaks, it's very likely to have a large move in that direction because it's broken this support level. It's not overextended. It's unlikely to fake lower and continue higher, because also looking to the left side of the chart, there isn't great support levels to look at. It had a kind of a pretty strong trend up. And so big picture, this trend could be reversing and having a pullback before, it does whatever it's going to do next. And that's where if you, wondered what this would be doing next on a bigger picture, you could zoom out even more to, let's say, like a 60-minute chart or even a daily chart. And that's where, ignore all the random little drawing time frames because those are incorrect. We're on a daily chart right now. But, looking at a daily chart, this is where I would think, okay, we're in a clear big uptrend. We might be having a bit of a pullback here, but I'm assuming we're in an uptrend until we have a clear pullback and a double top and something's starting to fail here. And that's where time frames are really important to understand. Of just because on a daily chart right here the NASDAQ is in an uptrend doesn't mean that if I go to a 5-minute chart or a 1-minute chart, I'm not going to be looking for a short on a shorter period time frame. You can still be looking for shorts and longs. It just depends on what time frame you're looking at and what those time frames are telling you about the market. And so what's really important and helpful is understanding just basic candlestick patterns. What these will do for you is, once you kind of understand how to read markets, you don't really need these, but it's a good cheat sheet when you're first starting. Because if we look at this, here is a descending triangle, and it's basically saying, okay, the market has a horizontal support with a downwards trend line, and the trend into it was a downtrend. And so once it breaks this to the downside, this support, it's saying it's likely to continue lower. And if we look at our NASDAQ chart, well, you can see we pretty much had a downwards descending triangle right here where it had that support level and then a downwards trend line. And then once it broke that, it had a really big move lower. And so that's a really good way to use these and match them up with what's going on to help you understand when you're starting to learn these as a beginner. And so when it comes to actual candlestick patterns as well, these can really help you break down some smaller patterns of what could potentially be happening right at these inflection points. Now, these are all reversal patterns. Once you kind of understand what they mean, it really makes a lot of sense. And so, for instance, here, this one, it's a V reversal because you have a trend coming down quickly, and then you have a hammer candlestick pattern where the market essentially just goes like this in that one candlestick, and then big picture, it continues higher. This candlestick pattern, essentially on a smaller time frame, what I'm drawing here is it essentially just makes a double top. And a double top is a larger, bigger picture structure reversal pattern. And these ones right here they are a momentum switch where the market is going down, in this case, really methodically and starts to slow down. And then you have a massive switch in momentum. And so going through this will really help you understand how these can work. And another one is essentially consolidation, where the market either here it has it in a form of just a doji, or here it has it in the form of multiple candlesticks, where it has a downtrend, it starts to just go sideways, and then it moves up. So let's talk about the theory of supply and demand first. And so if we're looking at just like, let's say a market of gold, well, as the price of gold is really low, there's gonna be a low supply of it because there's not that many people wanting to sell it. Why would I sell, this gold bar that I think is valuable for a really low amount of money? But as the price gets really high, more and more people are gonna think, well, hey, I want to sell my bar of gold because I can get a lot of money for it because the price of it is really high. I'm getting a lot of value. But then on the flip side, for demand, well, if something's really, really expensive, like a bar of gold, I'm not gonna want it because I don't wanna pay that much money for something I think I can get for a lesser value later. And so as time goes on and as the price goes down, demand actually increases. And so you have imbalances where supply can be really high, but no one wants to actually buy it because it's overvalued. Or times where demand is really high, but nobody wants to sell it because they don't want to sell it for dirt cheap. And so in the middle here, that's where you have more of an equilibrium where buyers and sellers meet. And so when it comes to actually trading, what you can have is, and what you create is supply and demand zones. Based on stuff that we'll talk about in a minute of how you identify these, but based on past observations, you can start to create these and know that, okay, well, when the price comes down to this demand zone, it's likely that it's oversold, that the price is so cheap that there's likely to be a high demand, which will, over time, increase the price because more and more people want to buy it. And so the supply actually starts to dry up. And so if there's a finite amount of something, the price is going to go up over time as more and more people buy it and more people want it. But eventually it's going to get to a point where it's at a price where more people want to start to sell it because they can get a really high amount of money for it. And so the price will go down. And so quite often you'll hit these extreme areas and have strong moves off of them. And then you'll get into that more middle ground between the two where it has that equilibrium and it'll have more of a choppy market. And so this is why when you look at a stock chart, it's important to understand that these extremes are the important part to pay attention to, because you'll likely have the market bounce off these zones quickly and, like I said, chop around in the middle. And then it will, once it comes up to a level, you have that potential to reverse off of it. And so that's how you want to look at trading these levels. And so this is how I like to use them for trading, is I like to watch for key areas where I think that the market might find a supply or demand, and it's likely to reverse off of the supply and demand zone, and then you can capture a nice swing off of that. In this trade right here, the market came down to this demand zone down here, and I bought, went long, and captured a move up and made about $1,500 on this trade. And then as it came up to where I thought there was another supply zone, I got out of the trade because it's likely that it reverses off that zone, and I wanted to get out of my profitable trade and move on with my day. Now this is horizontal supply and demand zones. What you can actually have is trending supply and demand zones where the market is moving down slowly and it continues to move lower over time, but what you get is it starts to bounce off of supply and demand zones as it creates those. And so you can start to take trades as it tests these levels. Another way to do this is it can actually be created with more trend lines. And so every time it comes up to that trend line, you can think of it as a supply zone. It's just more horizontal. A good example of this is a trade I took recently where the market had a demand trend level down here that I wanted to take a trade off of. And so it bounced around, moved up higher, and then sold off to that level to where I thought, okay, it's likely that the market starts to slow down here. Waited for a setup that I like. A few key patterns that I look for every time that I'll talk about in a little while to enter in, confirm the trade, and then I waited for it to play out, and it eventually played out, moving up to the higher end of the range, and I was able to get out for a clean $1,200 trade pretty quickly. And so that's how I use supply and demand, because it's so powerful to simplify trading. There's so many indicators and concepts when it comes to trading, and I always found the best way is to focus on just one or two things, and supply and demand really changed that around for me. So I want to talk to you about the key concepts that I use every time I draw supply and demand zones, so I know that it's actually powerful and it's likely that the market actually reverses off of it. Otherwise, it's so easy, going into our first concept, it's so easy to draw supply levels everywhere and not know which ones are gonna hold and which ones are gonna break. And so for me, the first biggest thing is not looking at those levels in the middle of the range. I like to stick to then at an extreme of that supply and demand in the market versus being in that middle of that area, and you could have a chop and just not have something that's worth taking a trade. And so that's the first key concept, is stick to extremes in the market. I always find that for my trades, even though I have a 3 to 5 step checklist I look for every time I enter into a trade, it doesn't matter if everything on a 1 minute chart is aligning up perfectly and it looks like it's going to have a great trade. If the big picture isn't aligned and saying like, hey, yeah, I think that we could bounce to the upside, or that we're at a extreme where the overall price is likely to have a snap back, then there's no trade. This is the most important thing when it comes to executing and confirming my trades, is things being at an extreme and also the big picture being aligned with what I think is going to happen. Now, when it comes to drawing these zones, what I like to do is I like to see at a minimum multiple touches. So in terms of here, there's this swing right here, and then there's these two touches right here. And so what I did was I said, okay, hey, I think, when the market was trending nearly where it is right now, with that bounce we just saw, I go back multiple, this is me going back almost a month in data to find this level. And so I go based off of, okay, we have the extreme down here, and then we've also got a couple of bounces here. It looks like we kind of had a head and shoulders here, but essentially there's some chop in here and some bounces. And so that's, I think, okay, it's, why I draw a zone, and then I'm just gonna drag it across here to where essentially the current price is. And as the market came down here, I said, okay, I think it's likely we bounce off of here. And then it gets a nice, really clean double bottom. And then I go into a smaller time frame and look to see if there's a nice setup right here, and I can catch a big swing higher. And so the reason why I draw zones instead of very specific lines for my horizontal levels is because it's a supply and demand zone. You don't know where exactly it's gonna bounce. It's gonna bounce somewhere in this area. Every time the market comes down and tests a level, things are gonna slightly change. Maybe the market will come down here and barely test it here, because in this instance, when it's coming down to this level, well, there's some news out, or for some reason, a lot of people want to buy it now, and it's gonna bounce way sooner. Or it pushes further down, people are less interested in buying it until it gets to an even deeper extreme. And then that imbalance happens and people swoop in, pick it up quickly, and then it rockets up. And so that's why you can see there's a big rocket in this case. And so that leads into our next concept, is when there is a massive move off of a level, I like to key into that as well. Because if there is really aggressive buying or selling, it means that a lot of people came in the buying side, there was a lot of demand. And so it makes it more likely that when it comes back in the future, people are gonna wanna buy it. Or on the flip side, if there's a big selling, it makes it more likely that people are going to wanna sell when it comes up to this area. Now, most of the time, I like to just look at the last few days for a lot of my levels, because that's the most recent price action, and it's more likely that something's gonna happen based off of that. If you zoom really far out and you have a level all the way from back here, when the market touches that again months later, I find that a lot of the time something has changed at that point, and if it comes all the way down here, I'm gonna look for that to potentially break. Now let's talk about some keys of how do you know to the best of your judgment, because you never truly know and can never truly confirm if a supply or demand level is gonna hold, is it's how the market comes into that level. And so you have multiple trends where either you have a very fast-paced, extreme aggressive move, or you have a healthy trend with methodical pullbacks, where it sometimes even breaks the trend, moves around, chops, touches the zone, and then continues to chop a little bit. But essentially, how I see it is when the market has a very fast-paced move like this, it's more likely to bounce at a zone just like this move right here. And the reason why is because it's an unhealthy move. The market, when it just has an unhealthy move in general, even if there isn't a supply or demand zone, it needs some kind of pullback to create that equilibrium. And when it hits that extreme of this supply and demand theory graph, there's gonna be so much supply in the market. If we quickly go back to the concept here, is because if it shoots down so fast, there's some crazy momentum pushing it and pushing and forcing price to be so cheap down here. But at some point when it gets so cheap, people are gonna start buying it, and sellers are gonna eventually start to dry up, and you will have what is called a V bottom. And so you have that right here in this case. It actually did almost a double V bottom where it came down, spiked, supply kind of pushed it down lower one more time, and then as it hit here again, people came in and said, no, this is an amazing price, and it rockets up from there. And so this is how a volatile market works, because supply and demand is all over the place. And that is really, really good for trading. And for likely that a level will hold. Now, sometimes you'll have it to where it just blows through a level, and those are easy to avoid. And that's why one thing is, we'll get to my checklist in a minute, of why you have a reasons that you look out for to jump in and buy in an area like this. You don't just blindly say, hey, I'm gonna put in a limit order down here, a buy order, that when this price comes down here, if it does, I just wanna get long no matter what it looks like because I think it's likely to go up. Well, that's not always true, because supply can be so powerful that it blows right through this level, and you have to look at the next level. And so those unhealthy trends, when they do start to lose a little momentum, I find it's likely that it reverses, and those are the best trades. Now, when a zone is more likely to break, is, if maybe we can find a quick one here, is this was a pretty good zone right here. You know, this was the zone I was watching for a while. We had multiple touches up here. You could even drag it down and take this swing. This is a clear swing where it came up to that zone, bounced off. We had a lot of chop up here. It eventually sold off. And when the market came up here again, well, I'm looking at the big picture. And so the big picture is we've come down, sold off. There was a big news that caused a spike. The whole time after that news, the market was just kind of chopping back and forth. And well, pattern wise, this is a bull flag right here. And if you look at the lows, they're essentially getting higher and higher. Every time, after the first couple times, the market would make a push up here, the swing low would get higher and higher. And what that means is people are coming in and buying the extremes that where it gets pushes to the downside sooner and sooner. And so as it starts to, in my eyes, has a healthy move up here where there's moves with ups and pullbacks, and it starts to kind of sit here, and you know, it kind of sat here and chopped around for a while, and it sold off, and then it comes up here and starts to sit here again. To me, that makes it way more likely that it continues higher. And this is actually one of the trades we looked at a minute ago that I just quickly showed. This is where that trend line of trending supply and demand worked out as well. You can also see as the moves move up, it creates those with the swings. And so this is the cleanest one right here where it popped up, sold off a little. And so you could say, well, this is a micro supply level, came back down to here, broke that, hit another supply level. It was kind of the highs at this point. Big area where it's likely to sell off, sold off, and then at this point you have multiple touches here to where I drew this trend line. This was actually before market opens, where it came up and it hit this demand trend line and also hit this previous supply level that turned into a demand level. So that's the interesting thing as well, is levels when they're broken can flip. And so in this case, and this happens all the time, where you have a high and then the market breaks that and it comes back and tests that high. And you can see this all over the market. If you just zoom out and kind of look, you can see here's another concept of it happening where the market came up here, put in a high, kind of sold off a little bit, broke above that, and then if you pretty much just draw these highs, it came up, bounced off of it, and made an attempt to keep going higher before the market started selling off the rest of this day. And so that's where, when I'm looking at the market come up into a level in a healthy way, into either a supply or demand level, I think it's more likely to break that zone, and I will avoid betting to the downside. And so even though the market came up to this extreme level that I was watching, and instead of betting to the downside, I said, okay, I'm not betting to the downside. I'm just gonna sit out on that potential trade. And I looked to take this long right here, betting that the market was gonna break and go higher. Okay, so first off, some basics about scalping. Scalping, the whole idea is you are taking small trades on a small time frame chart. I enter in trades on generally a 1 minute chart, and I'm essentially looking for just capturing like a move from here to here. I'm not looking for a massive swing in the market. If we zoom all the way out, I'm not looking for a huge move over multiple days. You're going into a small time frame chart and looking for a quick move to happen. The trades are generally really short in length. You can see here, this one I entered in on about 7:46 my time, and I ended up getting out about here, which was 7:48. So it literally took me like 10 or 15 minutes. They're very fast. Sometimes they can be long, just if depending on the market, but generally if there's good movement, you're gonna be in and out of a trade very quickly. But the whole idea of this is, think about yourself as like a sniper in the army. You are sitting there patiently waiting for the perfect shot or trade setup to happen. I took this trade this morning, and I haven't taken a trade all week. I haven't taken a trade. If we zoom out to a larger time frame chart, here's 1 day, 2 day, 3 day, 4 day. It's currently Thursday. I didn't take a trade this day, or this day. And so it's a lot of waiting. But the idea is you're waiting for that perfect setup or almost perfect setup to happen. And then when you jump in, you can make a lot of money once you've sized up. A lot of mistakes that people do, and that I did a lot when I first started out too, is trying to capture every move, is trying to capture this move and then capture this move. And it's impossible to capture every single move in the market. Instead, I found it to be way more consistently profitable is to wait something like all week for a really clean setup. And then the money you make comes from sizing up. It's easy to get stuck in that trap of, oh, well, if I make $100 every trade, well, to make $1,000 this week, I need to make 10 trades. And taking 10 profitable trades without any losers is really hard to do. Trading is really hard at the end of the day. And so I find it way easier to be super patient during the whole week. And once in a way, a perfect setup shows up, that's when you can jump in, because a lot of the time, if you look at it, the rest of the day, once this move happened, the market's just choppy and it's really hard to trade. There is movement in here that you could theoretically make money off of, but that's really hard to do consistently over time. Another big issue that I had in the beginning was going for a small amount of money with my trades. Is going for, let's say, $50 and I'm risking $100. What this does is it gives you a negative risk reward ratio. And so what you want to do is flip that. And so I found it to be way more consistently profitable to have something like a 1-to-2 or 1-to-3 risk reward ratio where I'm risking, let's say, $100 to make $200 or $300. And so I find that extremely important to do. A mistake I did that I highly recommend you not doing. Trading when you first start out, you really want to jump in and make a lot of money, but that comes with time. Instead, focus on the patterns and consistently trying to execute something over time. The process is the most important part. It takes a long time to get to the size I'm at and to be able to make an actual lot of money from trading. Okay, so what I want to do now is go through my trade entry checklist for you in a very structured way so you can then know exactly what I'm looking for, and then we can go into some real examples so you can see what it's like in real time, because on paper it's a lot different than when you're actually looking at a chart, because at the end of the day, the charts are all over the place. No trade looks the exact same. And so the hard part is to be able to, take something like a simple entry checklist and consistently use that same thing for every trade. And so the whole idea behind my strategy and what really helped me simplify things is I literally only look for reversal trades. I only look for spots where I think the market is going to reverse. I look for a trend to move into that level. I look for a couple steps we're about to go through, and then I look to enter in and take a short off of that level and capture a move down that the market has, generally in the first 50 to 30 minutes in the morning. And so the first thing that needs to happen for that is drawing and marking off those key support and resistance zones. And generally I do that from a 15 or 30 minute chart. Most of the time it's from a 15-minute chart. And then for those zones, I like to have, at least 2 major swings. Again, make sure to check out that other video with those key steps, but I went through a lot of them in this one already. And it's important to stick to the extremes of those zones and levels. That other video will go a lot more through that. But so step 1 is needing that big picture reversal zone. It's not worth it to get bogged down in all the little moves that the market's having. Stick to the extremes, because at the extremes, you're more likely to have a larger snap and a clean move that's easy to profit from. Now, step 2 is the second big key. And so these go in priority of importance. Step 1 is the most important thing. If you don't have a clean zone to reverse off of, there's no trade. Step 2 is analyzing that trend. If it's not clear and you don't have a good understanding of the trend, do not take the trade. I have taken so many trades where I wasn't quite sure and they always end up losing. It's hard to be patient, but entering in a trade only when you're the most confident is gonna increase your profitability a lot. And so I generally enter in on a 1-minute chart, sometimes a 5-minute chart, but I really have been sticking to a 1-minute chart these days. Simpler is always better. There needs to be a clear trend shift. A lot of what that means is just some of those basics we were talking about. Is there's a downtrend and it's clearly broken, and there's it's starting to make higher highs and higher lows. Another thing, it's not complicated, but again, it's extremely important. It needs to be clear that there's something like a big flush. The trend is clearly starting to either reverse or it's overextended and likely to have a volatile snapback. Those need to be in place. I've taken trades sometimes where, if we cut that out here and you look at this right here, where the market was having a downtrend right here, and it's starting to slow down, and it looks like this is making a higher high here and a higher low. But if you jump in a trade too early without enough confirmation, or without a nice snap like this, where it really shows the overextension of the market, well, you would have jumped in a trade here betting to the upside, and it would have knocked you out of loss. And that's the hard part about trading, is waiting for that really solid confirmation. And so step 3, we haven't really gone over this stuff as much. So this is a lot of the really important part of, okay, when do you finally confirm of when to enter, and when, what are the final confirmations? And so what we've been doing a lot of the time is looking at the big picture. Now, how do we look at the smaller picture and some of the micro patterns and actually know when to enter? And so, kind of a huge important part of step 3 here is, like we talked about, no choppiness in the market. You do not want to be entering in when the market is like this. Now, on this day, there is a little bit more volatility, but again, if I go back to the day before, extreme choppiness. Do not enter in that. It's hard to be patient, but you have to learn to do that. If you can't learn to be patient, you're not gonna be a consistently profitable trader. I can guarantee it. Now, some of the clean, consistent patterns I like to look for are either, a double bottom and just buying right there as it breaks the high, because this double bottom is nice confirmation. The market has essentially right here with the double bottom, that's to me showing that the market is, if it's in a downtrend, it's gonna make a new low. But if it makes a double bottom and starts to make a new high, that's a good enough confirmation that the micro trend is starting to shift. Again, remember, this is stacking on top of that. It's already at a clear support zone, and the bigger picture is aligning that it's in an area that it's going to reverse. Another huge pattern I like is actually a head and shoulders pattern. And really all this pattern is, if you look at it, is it's just the basics of the swings, of showing you that, it's now it's from going from higher highs and higher lows to making a lower low and a lower high. And that's a good signal that it's going to start going down. Now, the reality of this can look a little different. Sometimes it's not going to perfectly make a double bottom here. It'll sometimes make a higher low and then a lower low. That's actually generally a better signal. If this low breaks this low, it's just sooner showing you that there's weakness in the market. Really, that's all these swings are telling you is, okay, if it can't make a new high here, that's weakness. If it makes a new low here and breaks this previous one, that's weakness. If this low here starts to sell off sooner, that's weakness. And that's what you want if you're betting that the market's gonna go lower. And on the flip side, it's the exact same thing. And there's some other key patterns here I won't go over right now, but this sheet is part of a free 14-page PDF guide with a ton of these different patterns and kind of key importances to the pattern that you can download for free. I'll leave a QR code on the screen or a link in the description of this video that you can find it at. Now, the next last thing here is the candlestick confirmation. This is basically, okay, I am about to enter into the trade. This is the last signal that I need to look for. And this is, now you're starting to dive into the actual candlesticks. You're getting smaller and smaller as you go through this checklist. And what I like to see, these are some 3 patterns that I like to see, either really strong candlestick strength in the reversal direction I'm looking for, an engulfing candlestick pattern, or a 3-line strike pattern. And so the 3-line strike pattern is essentially, if you're in an uptrend here, is basically it's showing you there's strength, and then all of a sudden there's a massive move. And so what this massive move tells you is that it's hit that point where, you know, all these other things are stacking. This is essentially, think of this swing right here as the lower high in your head and shoulders pattern. And so what this is showing you is, okay, there is a lot of bearishness and strength to the downside as this lower high is forming of the larger head and shoulders picture. And so from there, that's when I would enter in at the close of this candlestick and bet that we go down. And then it will theoretically, if it plays out how you want, it'll start a downtrend. And so again, this is another section of that PDF. And then lastly, entering in the trade, a few key things that are very important is, again, we went over this a little bit in the beginning, stick to that 1-to-2, 1-to-3 risk reward ratio. In the beginning, I suggest going for a fixed risk reward ratio where you enter in here, let's say, betting that the market's gonna go up, and you're gonna take a profit at, let's say this is 2 times your risk. And so your risk would be down here. And so you would, let's say, lose $100 if it went all the way down here, and you would make $200 if it gets all the way up here. And you don't mess with it, because maybe you go break even, you move your stop to break even to where you lose 0 on the trade as the market moves, let's say, up here. But don't move your profit target away. Try not to move your stop too much, because when you're starting out, once you're in a trade, there's a lot more emotions, and knowing how to adjust and deal with that in real time and read the market properly and not have your emotions control you is really hard. And it's likely that you get out here early because you're scared or nervous or greedy, and in reality the market was just having a little bit of a pullback, and then it's going to keep going higher. And so I highly suggest just sticking to a fixed profit target, and then over time adding that flexibility in. Another huge mistake a lot of beginners do is, once you have your stop loss, do not move it further away. You're increasing your risk on the trade. Don't get married to one specific trade, because we have no idea what the market is going to do. No matter how perfect your entry looks, the market could just do a little bit of bounce and just continue lower. Do not increase your risk. Just take the loss, get used to losses. I have something like a 40% win rate, 50% win rate, but because I have that profitable risk reward ratio that's in my favor, it plays out in the long run. Same thing with this, is kind of going with those. Plan your exits before you enter. Do not jump in the trade and not know where you're going to jump out with your profit target or your stop loss, because they're going to change when you're in the trade. You're going to make different adjustments based on the market and how your trade is going. And instead, what you want to do is have a plan before you enter the trade, so you can stick to that consistently. Okay, so now I want to jump into some real examples here so this can really be solidified for you. I want to talk about a couple of actually really important factors for the strategy and entering into these that I just forgot to talk about. And then as well is go through kind of these real examples, because the market's never the same, no trade is the same, but these are really important to help solidify, and also to show you that I'm looking for the exact same pattern every day, that I really just sit here and look for the same thing. It's boring, but it works. And so to go through that list, the first thing I do every morning is I actually zoom out to a 15-minute chart. The market opened up like this morning, where it was clearly we had a lot of volatility the day before. And so what I was looking at for here was the highs here. Those are really far away, so unlikely we're going to touch those. But I was looking at, okay, here is the low from yesterday. That's important to look at. And if we get far enough down, like I talked about earlier, is that gap was important to look at as well. And then I just go into a smaller time frame chart and essentially wait for the market to open. And now a big key actually is, if I go back in this recording, is there's these 2 red lines right here. And so what I've realized over time is, so I'm trading the S&P 500 futures and the NASDAQ futures. And so they open up at 7:30 my time. And I've realized that over time is that 15 minutes and 30 minutes after those markets open are times where it's likely to reverse. So today, either it comes down here and hits and reverses, or it continues a bit lower or chops here for a bit and then reverses at that 8 o'clock time, which is 30 minutes. So technically it would be 9:45 and 10 a.m. Eastern Standard Time. And so that's really those timings that I look for every morning. And of course, I need that to align up with those other potential factors we're looking at. And so today, what that was going into this was, we've already talked about this downtrend a lot, and then this flush lower we had, and then you can see it started to slow down here. We had some choppy candles, and then we had a big bullish candlestick, and it starts to come into that timing window of 15 minutes after the open, where essentially what I'm looking for there is a flush at the open and it to slow down here and potentially reverse, and that to align up with factors that are showing that the market will reverse. And having this support zone here and then having this downtrend was a huge factor in that. And then the last thing is going into looking for those candlestick patterns to enter in on, like a double bottom or a head and shoulders pattern. Now this didn't have either of those. What this had instead was a higher low, where the market comes down here, puts in a bottom, and then makes a higher low, and it continues higher. And so this is okay to enter in sometimes because the market's moving so quickly, and that's the only signal it will give. Other times, I like to wait for a more cleaner double bottom pullback. But in this case, I was comfortable jumping in long on this as it essentially broke this higher low here. And so you can see I put in essentially a buy stop order right here above this high. Once it essentially breaks this swing high here, I'm gonna get in on a long and I'm gonna bet to the upside. And then my stop is below this swing right here. And so I'm risking about $1,500 on the trade, and I'm looking for roughly about 2 or 3x. And so that's what I'd like to see on the trade. But obviously, as the trade plays out, I'm looking for areas where it might slow down. But this trade, you can see zooming through this footage, is it happened very, very quickly. I didn't really have any pullbacks that went against me. It kind of just shot up right away. And so in that case, what I did is I elected to get out pretty quickly. I was gonna get out at 4x my risk with a limit order if it went all the way up there, but if it started to slow down at this resistance zone I had drawn, I would also just get out on a trailing stop. And so there I essentially got out on it, made a little bit of pullback, and I got out right there for pretty much $4,500 in pretty much 10 to 15 minutes. And so to show you another example of this, just to show you how repeatable this is, but also these are trades I've taken where I've waited for a couple of days, right? It's not showing up perfectly every time, but this is a perfect example, again, with a couple of different nuances to it. And so first off, every day, I come in and, okay, these are the levels I'm looking for. There's a big bottom here with another higher low. And so my thought is, okay, well, if the market comes down here, I want to look for a bounce. And also there's a little resistance level here. And so once I draw those, I go into, a smaller time frame chart. I draw those red lines of those keys where 15 minutes and 30 minutes after the open that I want to see a reversal. And then essentially as it comes into that reversal timing, just like this last trade, is what is the volatility going into this. And so on this day, there's good movement. Again, these are cherry picked days in the sense of I'm only taking trades on days where it's good. You're not going to see movement like this every day, but there's no point in showing you, recordings of me just sitting there not taking a trade, right? And so those days I'm just sitting there and, I sit there for 30 minutes and I move on with the day. But days like this, where there's clearly movement in the market, and what I'm looking at is right here, you can see I literally draw it exactly how I want in the recording. I'm trying to visualize, okay, we're in a downtrend here. That downtrend has broken with this trend shift right here in this candlestick. What I want to see is if we make a pullback here, and then that would signal essentially making a higher low pattern, which would then I would like to enter in once it broke this previous high, and I would capture a swing up, ideally to the market open. Huge thing about these swings and these flush moves I've noticed is it pretty much the easy money and the easy move is when it reverses that move back. It has a big move down here, and then I essentially want to just target this move back. Now it could continue higher, and now that I'm a little more seasoned with managing these trades, I can try and hold on, but sometimes I'll just close out because I think, no, that's the easy money. I don't think there's good potential to continue higher, reading the big picture. That's where the experience comes into play. But this is essentially me being like, okay, that's what I'm looking for today. And so it's hard sitting and waiting through this move because the feeling is, well, what if it just shoots up and I miss it? That happens. But I'm risking, so much money here that I don't need to be in a trade very often. I could take one of these a week, and if I won every time because of how patient I was for a good setup, I would still be making like 20K a month. And so trying to keep that in mind to help me be patient is really good. And so the market here, if we watch this, it made a pullback here. And so I'm planning that I'm gonna put my stop loss below this candlestick here if it ends up being really bullish. And then I'm gonna enter in as it breaks above this swing, because again, that's a confirmation that it's making a higher high. And so I slightly missed it there, but then I entered in and put an order, jumped in essentially as it broke that, put my stop loss where I had planned, and I'm looking for 2 or 3x in profit. And so essentially at that point, I'm not gonna go into managing too much here, but I moved to break even essentially once it got to the market open where I see a potential for it to reverse, but I didn't wanna close out there because I still like the potential to go higher. And then from there, I just managed with the swing and the movement of the market, eventually getting out at about 2.5 times my risk for about $4,500 again in pretty much 15 minutes. And then I just move on with my day and I'm done trading. And so what I wanna do is I wanna walk you through 3 different trades over the years of scaling up from a smaller account to a larger account. You're gonna have different steps along the way at different account sizes of how you manage your trades, how you enter in. And so it's gonna be really crucial for you as a growing trader to watch how I trade and enter on each one of these trade setups we're about to go through. Now, don't forget to get that 90-day trader roadmap in the description of this video. It's gonna have a ton of those helpful links that we talked about, but also a ton of step-by-step helpful information that we just haven't gone over in this video that you are really gonna wanna be paying attention to as you go through this process of figuring out your strategy, even if you don't use my strategy, but figuring out your strategy, figuring out how to become consistently profitable with that strategy, and just consistently execute the strategy. That is the hardest part about trading, is getting consistent. So let's start out with the first phase here. What you should be doing when you first start out trading and risking a small amount. In this trade example right here, this is a real trade I've taken on a small account. I'm risking about $100 per trade here, and you can risk a lot less than that. I'm trading 5 contracts here actually, based on this number 5. So you could do 1/5 of that. You could be risking $20 on this trade. So you can start really small. And what you wanna be doing when you first start out is you wanna be just going for quick, easy wins. You wanna keep your management of your trades as simple as possible. Now, first off, I wanna get in a little bit more of how my strategy works and how I actually find these trades. Now you can see initially, I am betting here that the market is going to go down. And so you can make money betting the market's gonna go up, or you can bet money that the market's gonna go down. It's really, really simple. You don't have to do anything complicated. It's called shorting, and it sounds a little complicated, but really at the end of the day, you are just clicking a sell button instead of a buy button, and you're making money as the market goes down, which is actually in your favor in that case. Now, the first step to every trade I take is finding those big picture resistance or support zones. And so for this particular trade, if I go back in the chart and look, is that the market was coming up to this area, and just looking at the big swings, we had touched up here twice already. And so I drew
this box. Now I'm not going to go over these. I'll link a video that dives way more in depth on how to draw support and resistance levels and the 5 key things I look for. But essentially I said, okay, I like this area in the market. You know, resistance and support zones can be pretty subjective. You know, you could be up here, you could be down here. But the idea is if it comes up anywhere in this area, I want to look for the market to potentially reverse, right? And capture a move down off of that area. And so I draw these levels off of a 15-minute chart. And then I enter in my trades on a 1 or 5-minute chart. What this does is, drawn on a bigger picture time frame, is it just allows you to see the bigger picture. And I always found that the higher levels, that the levels from there are just higher probability because they're on a bigger time frame versus the smaller levels. There can be a lot more whipsaw back and forth. And so the market right here that we're looking at is coming up into this support level here. It doesn't pop up on this chart here because I think it's slightly out of view just because it's kind of that big picture. But that's my idea here, is first off, we're coming up into that level. And then the second step is, well, there is this big move up here and I've drawn an uptrend line. And all I'm looking for is, because when you're counter trend trading, well, you kind of need to make sure that, you know, the trend that you're going against is over, right? And so there's a big move right here. And I'm thinking, okay, I like this to go back, thinking about that rubber band effect we talked about, right? It's likely to come up, and if it gives that back up, it's gonna snap back, and oftentimes it'll snap back to kind of where it started. And so what I'm looking for here is I'm looking for it to do that. And I actually have a buy limit down here that it almost just hit and then is reversed off of a little bit. And so that's all I'm looking for, is just that quick move. And what you wanna do when you first start out, I highly suggest this, is go for a fixed profit target. Now I do it a little more complicated here because I am more advanced, trading on a smaller account. But if we zoom back to the start of this trade, is all you need to do is, when you enter in a trade, is enter in here, and then I like to put my stop loss where I'm gonna get out if the trade goes against me is in a key area, you know, essentially above this swing here. Because I think that, hey, I think this is a rubber band effect. It's likely to snap back. It'll do that quickly if it does. And if it's just in a strong trend where it's just gonna bounce and keep going higher, cut your losses, right? Remember about that risk reward. We wanna just risk that $100, lose the $100 if we're wrong, or if we're right, you know, we collect $200 or $300. Because the worst thing that you can do as a beginning trader, and I see people do this, is they'll take their stop loss that sets at, you know, at $100 of risk, and they'll say, oh, let me move it up here a little bit more, or a little bit more. Give the trade a little bit more wiggle room. And most of the time, the best trades happen and work out quickly in your favor. And the ones that don't, they're just not gonna work out no matter how much room you give them. And so it's better to just cut your losses and move on. And so once I jump in here, that's what I'm looking for, is the market to kind of give that move back up. That's a great target. And so when you enter into a trade, you want to make sure there's that room to profit. You want to visually see, okay, this rubber band can give me about 2.5 times my risk in profit if it goes down to that area. Because if it doesn't have that, it's not worth the risk. There's no good opportunity there. That's your edge in the market, is making sure that there's opportunity for you to put that limit order in an area that makes sense. And so you can see, just kind of looking at the movement of the market, it's kind of in an uptrend right here. And so I was keeping track of, well, there's this uptrend here. Keep in mind, we could come down here and the bigger overall trend takes control and we push up from there. And so that's a little more advanced market reading there. But the idea is, you know, we have this small move that I'm looking for the market to give up. And then that big picture level, you know, hopefully comes and stacks onto this and pushes it down even more. And so the last thing to jump in on these trades is, I like to see a candlestick pattern. I like to see some kind of head and shoulders pattern, you know, a pattern where there's a big bearish bar here, you know, a 3-line strike pattern essentially. Or you can see here as well, this candlestick. The market essentially, if you look at what these do and if you kind of read into what they're saying, the market kind of came up here in this uptrend and then it sold off, and then it made one more attempt to go higher. That's what this candle is showing. It attempts to go higher and then it comes back down. And so what that shows me is there is essentially a micro double top here. And in that trend, in terms of giving back this rubber band effect,
that's a really good signal to jump in short here and bet the market's gonna go down. And so from there, just set your limit order and just leave it. Now, I do suggest when it gets close like this is you can move your stop loss at least to break even, but generally it's better to just try and just focus on your entries. What you want to do when you're first starting out trading is master the entries of getting in. Managing your trades will get you a little bit more money, let's say increase your profits by 10%, but your entries are going to be 90% of what makes or breaks your trading. And so learning to just focus on those and not think about the management as much, because that just adds, again, more variables, and the more simpler you can make trading, the better. And so just to walk you through kind of what I did here is all I did was, it almost hit my profit target there. And I thought, hey, I see it in this downtrend here, and I'll just move my stop down and see if I can get a little bit more in the trade. And we'll talk about some more complex management steps in the next phase here, so you can know kind of what to do when you get a little more comfortable reading the charts. And so my trade pretty much got knocked out here, and I think about 180 or something, so about 2 times my risk, which was still pretty much what my target was at. And so that's, again, a great trade, and you just move on to the next one. And so let's jump in right into phase 2 and our second trade, where I'm actually risking, I think, $200 to $300 of risk here. And then this is what you want to do once you become a little more comfortable with trading. And you can see that this is a very, very similar setup in terms of just the market moves up, it comes into a resistance level that I'm looking for, and I'm just looking for that rubber band effect to move the market back down. And I found that this is just really, really repetitive and consistent. That's how you make money trading, is not learning 10 different strategies or 10 different patterns to make money off of. It's taking one strategy, keeping it simple, and scaling up. You can trade $100 with this pattern and easily scale to $1,000. It's just a number at the end of the day. It's gonna get a little more stressful at $1,000, but that's why you slowly build up to it so you can get used to that amount of money. When I first started out trading, risking $50 felt crazy and super intense. And now, at a blink of an eye, I feel like I can put $500 worth of risk on a trade. You just get used to it. And so to walk you through this trade entry and then how the management style can change over time is, first off, is again, always looking for that larger resistance level, just off of those swings, off of a larger time frame. I use a 15-minute. I have some students who use like an hour time frame to do that. And then it's just seeing, okay, we have a good trend here, but it started to kind of get overextended right here. You can see with these 3, 5, 10 candlesticks that kind of started to skyrocket here, and then it started to slow down. And so for me, I see that as, okay, well, I see kind of an uptrend here. It's kind of getting methodical, but it kind of got overextended, and it's near that area where I'm already expecting it to reverse. And so having that as a combination, it stacks on top of each other and increases the likelihood for it to happen. And then from there, it's just looking for that kind of a candlestick pattern to show it's starting to reverse. And for me, that was, well, we had a really big sell-off right here. These 4 red candlesticks shows a lot of selling. And if you look at, we hadn't really had that much kind of selling pressure, 4 candles in a row for quite a while. And once it's kind of moved up here, especially after this, I think that's a good combination with it coming here and making 2 lower highs. And that's the whole thing, is just reading the basics of, okay, well, uptrend is made out of higher highs and higher lows. And when it's gonna shift, well, it's gonna start making lower lows and lower highs. And so here it makes a higher low and then a lower low. And then here it's making 2 lower highs from this peak that it made. And so from there, I elect to jump in short on this bearish candlestick right here, because the market, if you kind of read into these 2 candlesticks, it shoots up and then it shoots lower, kind of confirming that lower high. And so for me, that's a good enough confirmation with, the support level, the uptrend broken, and then those lower highs coming into play. And then of course, looking at the bigger picture of this kind of rubber band move up,
likely to push lower. And then from there, I just jump in. And to kind of show you, once it kind of moves lower, now I've started to move into more of a fluid management style. The stop here is above this high right here because I think that, hey, this is a swing low. I'm assuming that we're gonna start moving lower off of that. And if it breaks this instead, and comes up here and makes a higher high, well, this uptrend's gonna keep going and I just wanna cut my losses, right? And so from there, it starts to go in my favor and I'm looking at more, okay, I'm not looking for 2 times fixed profit target anymore. I'm looking for 3 fluidly. And what I mean by that is I have a profit target all the way down here at about 3 times my risk. And as it starts to move in my favor, I'm gonna move my stop loss further down. And if it really gets going, I'm gonna move this further down as well. And I'm just gonna slowly move my stop loss down and my profit target down. But I'm also gonna manage with how I see the market moving. And in this case, the market starts making a really tight downtrend right here. And often I've observed when I see the market coming up here in a clean, methodical way and then making a really tight downtrend, I want to capture this move here. But as soon as it starts to, become a broader downtrend, I don't want to hold through those pullbacks and swings that the market could have, because at this point, well, it could actually bottom and start an uptrend right here. And so what I decided to do was essentially manage with this downtrend line. And so that's something new that I started doing as I became more comfortable with understanding the market and being in a trade, is I would be okay to, as soon as there was a candlestick close or 2 outside of this trend line, or with the idea of saying, hey, if it breaks above this candlestick, it's probably breaking above and out of this trend line, I'm gonna close out and get out of the trade. And so there, I closed out for a good profit, captured this, move down. And I think from there, looking at this, it looks like we could have a retracement up. Now it could come up here and keep going lower. But again, I've captured the easy money and the part that is just good enough for me at that point. I don't want to deal with the choppiness of the market and the fact that it could just give all those profits back up. I, am reading the movement of the market. Now, of course, sometimes it can just have a little pullback and puke lower, and that's a part of managing your trades. So now let's go into another trade where I'm actually risking $600 per trade. And let me walk you through the intricacies of how to scale in and scale out of a trade. This is definitely a lot more complicated, and so I highly suggest don't do this when you first start out, but it shows you the power of how to do it. This is actually a long example of a trade. We're in that big picture support zone. We've actually kind of broken out of it. That's okay. I like to call those a failed breakout. It's just attempting to fail and break out the other side. But, I have this downtrend line in place, and then you can see there's kind of some big moves up here that shows strength to me. And then we have one more push lower. I see this as a final attempt to go lower. And then right here, boom, we have a double bottom. This is a nice bullish bar. I think at this point, it's essentially confirming a double bottom here. And I think it's worth jumping in a trade long here, putting my stop loss below here and getting long. And so the first thing though with that is I didn't feel super confident right away, just because it felt like there was a lot of downwards pressure right here. And so I elected to, give it a couple candlesticks here. See, okay, if it's gonna make one more push lower here, boom, I definitely wanna get in. If that candlestick reverses, I think that's showing a lot of strength. So I jump in there, but I'm actually not full size here. I'm 2/3 size. Full size here for $600 on this particular trade is 3 contracts. And so what made me more confident was waiting for this candlestick to close out really bullish. That I thought was a strong signal, a strong bullish bar. It had, made this kind of little couple dojis here, and then it had made this strong candlestick. So I put in an order, a stop market order above that, essentially getting in long at the break of this candlestick. And then I matched it down with my stops down here. So essentially that made my total risk to be $600. That's kind of my full size at the time. And so one thing, what you can do is you don't have to necessarily scale in. You can also just trade smaller size. Let's say full risk is, $600, and that's, 3 out of 3.
But you can also just trade 1/3 size and that's it. You know, you could just risk $200 on a trade because, you know, you're not as confident in it. The level's not as strong. There's not as much of a, you know, flush like this, right? And so that's what you can do is when you're not as confident in spots, or if you're just not feeling on top of your game, you can trade smaller size as well because of that. And so that is 2 ways to kind of change how you enter into trades, because that's going to allow you to control and manage your risk. And really good trading is when you control and manage your risk. When, if you're not confident, but you still think it's worth putting a trade on, you do smaller size. And when you are confident, that's when you put on larger size, because when it comes to trading, no 2 trades are the same. You know, all these patterns are very similar, but they're not the same at the end of the day. You know, the market's always different. And so over time, and by the time you get to here, you're gonna build that intuition into knowing kind of when you want to put full size on and when you want to put smaller size on. And so once this kind of broke out to be 2 times my risk here, I moved to break even because, you know, there's no reason to let it come all the way back here and turn into a loss, right? And so what I'm looking for at this point is I'm just kind of giving it a mental stop at this point. If the market pulls back all the way here and just flushes and knocks me out, it'll do that and knock me out at break even. That's always what goes on in my mind usually when I'm doing this. But it's so unlikely that it happens. Usually, most likely what will happen is it pulls back, you know, and makes a couple candlesticks before, you know, deciding which way to go. And then you can move your stop loss above that. And so that's kind of what I did here, just to kind of skip forward to kind of show you that. Is it, you know, it doesn't look good. It's like, okay, well, maybe it's just going to give this back up. But you can see it starts to find a bottom here, and I then move my stop loss up, and we start to get some volatility here. There's a little bit of news that came out, and so that's why I don't like to do a profit target in some points, because, well, it allows you to have these massive moves where, you know, I think $1,800 was 3 times my risk, and this kind of move, well, I'm thinking, okay, well, we've come back all the way up to here on the left side here. You can see that we've kind of given back this rubber band move, but it allows you to have the potential to get massive moves. And if you look at other trades on my channel, I get some massive moves sometimes. And so to just walk you through quickly is I actually then started to scale out of this trade. And so what I did was the market had this big candlestick up, it had a pullback, and my observation with these is, hey, if it's gonna hold this, it's gonna hold it. And so I would rather scale out of 2/3 my trade there and, you know, capture those quick profits. But then also, you know, I have this uptrend here I'm watching. And so that's why I left one of these contracts on. Hey, you know, maybe it has a little bit of a snap here, knocks me out, and then it takes off and holds this uptrend. And so that's what I'm kind of looking for here. And it looks pretty good right here, especially since it barely knocked out my 2 other contracts, which it's a part of trading. It's gonna be frustrating. You're gonna have trades where you just barely get knocked out and then it goes thousands of dollars of profit in your way, and it just is what it is. You don't want to focus on those small times where, okay, well, maybe I should adjust my strategy to fit that little bit. You want to be, again, focused on the big picture of, okay, well, what generally works and makes me the most money. You can't control the infinite possibilities that the market has and that it's going to throw at you. And so now at this point, it's not looking that great, since it's pretty much just made this double top right here. And so at that point, I'm gonna move my stop loss essentially with the idea that, hey, it's breaking this uptrend, and, you know, I'm gonna get out. You know, I still wanna capture the profits that this move looks like it's gonna do. And so, you know, it has that double bottom here, and I just move my stop loss up to there, and it knocks me out. Okay, coming into today, I've taken a few days off from trading, and so it helps me to get back into the swing of things by visualizing what I want to do, reminding myself how my strategy works and what I'm looking for. You know, what is that repeatable thing that I'm looking for every day versus just kind of showing up and being like, okay, I'm just going to trade. And so for me, one of those big things is going into some of my recordings of just past trades that have done well that are basically just are wins that hit my criteria, and seeing that, you know, it's like, hey, I want to just see the market come up to a spot, and hit, kind of make a double top, hit my timing window, and then take a trade based off of that. And so for me, that helps me, you know, kind of trigger, okay, I'm not looking to just do random things or react to the market. I want to wait for a specific thing, you know, a nice spike, 8 o'clock or 30 minutes after the market open to show up, and then, you know, take a reversal. And that's kind of my bread and butter. And essentially that's what my repeatable setup is. And so going into today, looking for something like that. If we look at the ES futures, just to bring up my drawing tool here, on a 15-minute chart, you know, we had a crazy sell-off Friday, and this was just Trump announced some kind of tariff news on China. I think he tweeted it or something, but the market just went crazy over it. Like looking at a daily chart, you know, it was a huge spike down. And so, you know, we came to actually these previous highs, which I think is a great spot for a bottom. And if he doesn't really follow through, you know, the thought is it just going to be, you know, a smaller version of April where we just ripped lower. And then once people were like, oh, he's kind of backed off on that, we might just shoot back up. And because the market overall is insanely strong right now. And so I think it's totally possible that today, looking at this, we probably want to retest this to some extent, and we have done that. You know, we started to recover, pull back. This really kind of tested the gap we had. There's still technically, it closed here and opened here, so there's a pretty big gap there. But we have come down to really fill this gap. This is the major gap here. I haven't quite filled it, so I could see us selling off a bit more to do that. Same thing with the NASDAQ, pretty much exactly the same setup. Is we've had this downtrend or trailing off, started to fill this gap, at least tested the middle of it. And so going into a smaller chart, what that looks like for a trade today, well, you know, 8 o'clock is here. Sometimes you can get a reversal 15 minutes after the open, but today I think if we can get a good bottom, I think it's totally reasonable. Actually, going back to a 15-minute chart here, is if we target these overnight highs, you know, the market kind of just giving back this move up, finding some strength, but just got to pick the right time to buy at the bottom for that. And so market hasn't opened yet. Got 7:30 my time is when it opens, and then other couple windows I like, 7:45 and 8. These are my two spots where I want to see it come down and reverse. If it's, you know, either way at those timings, that's kind of lines up with what is repeatable for me, versus I find, you know, going into the market and just trying to enter in randomly just does not work very well. Or reacting and just reading and thinking I can read the market in real time, if it doesn't fit one of those kind of things. So another thing would potentially be, well, if it comes down, bounces and then sits here for a minute and looks like it's going to go long, maybe like a fake lower and then goes long, that could be another potential trade of a fake out lower, to again try and fill my bias to the long side. So what I would like for a long here, now that it's broken the lows, I would want a head and shoulders to go long here, because otherwise it's way more likely that we just, especially for the NASDAQ here, is come up here, test this, and just continue lower, because we're not really bouncing off of a support level. Now we could just be doing a failed breakout of the overnight lows here, but big picture, we could just be in a downtrend that's going to continue lower, you know? And so I don't want to jump in long here saying, hey, that's a nice failed break lower, when this downtrend is so strong. I like this to the upside. I really want to see, I'm nervous that I'm just going to it's just gonna pump me in and then rip lower, but I think I'm just gonna get in long through that nervousness because it's made a nice head and shoulders there. I'm gonna just put my stop down here. Adjust this slightly. And then target the highs. It's a nice setup. Maybe I should have my stop down here. It's just hard when it's such a rip. NASDAQ has kind of done the same, head and shoulders. I think it looks really solid in terms of a setup. We had a nice flush lower, nice little fail breakout lower. In terms of target, I mean, initial is going to be here. The previous open, or the open of today, which is basically here. If we rip up and hit 2x pretty fast, I might jump out. But I mean, ideally we try and go for the highs. But also one thing to keep in mind is pulling up a channel here, is we could totally be in this kind of channel right here. It's not super defined. You know, it's kind of off of these three, but that's pretty solid in terms of resistance. So there's this downtrend line here from that channel. If it does like a 2 candlestick pullback here, just like this, and then continues higher, I want to hold through that. I don't want to get ripped out by that. It's scary at this size, and I'm still getting used to that. And it'd be really frustrating if it does. But pulling back, you know, looking at the NASDAQ here, trying to be unbiased that I'm in a trade, pulling back to here and going higher is totally reasonable. Just kind of waiting to see what happens at this point. Okay, nice rip higher here. Again, looking at this, I'm just going to take this out to clean up my chart a bit. Being aware that there's this downtrend here, we could still totally just reverse after that pop up. And it could be like a final fake higher. Same thing on the NASDAQ. I think if we break my stop here, it's basically breaking this uptrend anyway. I'm happy with how I'm managing it. I just, emotionally, I really would love a win that's higher than $1,700 if I get stopped out. I'll be a little bummed about that. But again, at the end of the day, the entry was really good, which is what I've been struggling with. Management, you know, that just plays out how it plays out. It's just emotions talking, really. Big picture, again, this is such a good, for, you know, this whole swing, it's a nice fake lower and reversal higher. This is what I've been looking for weeks, really, with a lot of these openings, is reverse or fake the way I don't want, and then take a trade the direction that my bias is, or I think the big picture is. I'm just going to move this down to 3x at this point. I think that's emotional. I want to see how this plays out. I definitely, if this starts popping up here, I'm going to move trailing stop. Like really tight here now. Like up to 2x. NASDAQ is popping as well. For me, mentally, I feel like getting 5K on the trade is kind of a mental number I really want right now. It's not good, but that's just the reality. But I also don't want to just let that control what I'm doing. I want to run a trailing stop here if this is just going to continue to pop. I don't think that's over greed. I think that's, you know, I'm just going to put it trailing stop here right at the bottom of this candle. because I think either it's going to keep going up or it's going to knock me out. And if it knocks me out here at 4,700, I'm totally happy with that. Come on, hold and keep going. That's okay. I'm totally happy with that. So in the next few minutes, I'm gonna give you a complete crash course on how futures work. Now, the first thing is futures are not like your normal stocks and buying shares. You can buy a share of, let's say, Microsoft, and it will go up or down over time and you'll make or lose money, but you can hold that share for as long as the company exists. But with futures, you buy something called a contract, and this contract will expire once every either month or even 3 months, depending on what kind of asset you're trading. And this contract's value is tied to the physical asset. So let's say for something like gold futures, as gold goes up or down, your futures contract on gold will also go up or down in value, but usually it'll be a lot more than the price movement of gold. So what this allows you to do is get a lot of leverage on that specific asset. So for example, with gold, is you are essentially buying a contract saying that I will buy, let's say 100 ounces of gold at this current price in the future. And once that contract is used or expires, you have that ability to do that. But in practicality sense, nobody really ever does that, at least for, retail traders like you and me. What people do is they just buy and sell the contracts and get the dollar value increase or decrease of the contract and essentially trade using that. It essentially allows you to day trade with a very high leverage and able to capture up and down moves, just like trading shares. Now, to get control of these assets, you have to put up collateral. It's called margin. And essentially what you're doing is you have, let's say, $500 taken out of your account to get control over one gold futures contract. Now, this margin can depend on either what asset you're trading, how volatile the market is, or if it's during normal stock market hours, which is called intraday margin, or overnight margin, which is outside of normal stock market hours. Intraday margin is usually extremely low because the volatility and risk is a lot less, but overnight margin is a lot more, where you lose a lot more of that leverage potential, and it can take up to 10 times the intraday margin to get control over that asset. Now, you also have something called the micro futures, and all they are is they are a micro tiny asset of the larger normal futures contract. So if a gold futures contract takes you $500 worth of margin, the micro gold futures contract takes $50 worth of margin. So you can essentially trade a very small account. And what this allows you to do is start with a small account and grow it at a normal pace. You don't have to be risking a huge amount of money when you first start out trading. You can trade micro futures and risk $20 or $30 in one trade. Now, there definitely are risks when it comes to trading futures. The margin isn't your max loss on a futures contract. Technically, you can lose more than that if the market moves very quickly against you, especially if you hold it through the close. But really, in reality, I haven't really seen that ever happen. The way to avoid that is a stop loss, always in place when you're in a trade, and most of the time, your futures brokerage will close you out before your account goes negative and you start to lose a crazy amount of money. Now, the most confusing thing with futures is the price movement and how it's calculated. Every futures contract is slightly different. The minimum price movement is called a tick. So if you think about with shares, every stock, like our share of Microsoft, it can move up or down 1 penny at the smallest amount of movement most of the time because it's based on the dollar. Now, a lot of futures are not based on a dollar. With gold, it technically is, but something like the S&P 500 futures, if it goes up a numerical value of 1, that doesn't mean the index increases by $1 value. But instead, one numerical jump is called 1 point, and then the smallest movement possible, at least for the S&P 500 futures, is 0.25, and this is called a tick. A tick is the smallest price movement in the futures market that you're looking at. For oil, a tick is 0.01 and each tick is valued differently. So for oil, if you're trading the normal tick size, not the micro futures of oil, each tick or 0.01 worth of movement is worth $10. For the S&P 500 futures, each tick is 0.25 worth of movement and it's worth $12.50. And then the micro versions of those are just 1/10 of the size. And so you can see where the value and the movement of each chart is way different. Now, the cool thing about futures in the US, 60% of your profits count as long-term capital gains and 40% count as short-term. And so that's a huge tax reduction for long-term use of futures compared to trading other assets. If I double $50 just 10 times, it's over $50,000. But if I lose just once, the challenge is over. But I'm not trading every day. I'm only trading a clean reversal setup that fits my strategy. This isn't some gambling, flipping game where I'm just trying to see how much money I can make in a crazy amount exponentially. It's about showing you what's possible if you follow a disciplined, consistent strategy, and above all, have patience. So let's see how far I can actually get and put my money where my mouth is, starting with just $50. So day one here, I'm gonna jump in on a trade right here based off of a 5-minute chart. This is in gold. It's made a clean double bottom. We're at a good support and it's broken this downtrend. And so I'm gonna let it play out. Based on that, I'm gonna put my stop below this big green candlestick. The size is a little bit larger than 50. It's kind of hard when it's such a small account, but we're gonna see if this can reverse here and we can get a nice win initially. And I think it's about to pretty much close me out here at 1.5x, but you know what? First trade off $84, 120 up. If it does close me out right here, it's still capturing like $100. So I'm pretty happy with that. So I'm in the second trade here and it's going pretty well so far. The first off, the reason why I got in, we're looking at the NASDAQ. This is on a larger picture, time frame chart, 15-minute chart. We're here right now, but before we did a big bounce here, move up, you know, this is like kind of 2 days over the weekend, came back down here, and now it's in a good spot to bounce. And so that's why then I come into a smaller time frame chart here. And you know, this is a 1-minute chart now. You can see this trimmed down, pushed up, made some nice strong move. Kind of, it started to find some strength. And then when it broke out, bought in. And now I'm looking for it to pretty much just go back up to this high right here. Well, this challenge is gonna be really short. The trade is pretty much at full loss here, but you know, I guess that's how it goes sometimes. Oh my God, I kid you not. I literally thought it was done. Look at this thing. It reversed like just before my stop loss here, and now we're ripping back up higher. I'm pretty sure it's just gonna get me out at full win here for a second as this move is, that's a really nice pullback. Sick trade, I'm glad it didn't wipe me out. And these last seconds, sometimes it's just so insane just watching that just almost tick there and then not. Like I want to move my stop loss up right here and then having it pull back, it's just psychotic. I think I'm gonna move my stop loss up right here. So I'm nervous about this, but again, the reasons to get in are good. This could just be like a final push higher and if that fails. This candlestick right here is pretty strong. It's just a attempt at a new high and then it's gonna fail. I would like to see how this does this kind of bottom here and then continue higher. But I think if the NASDAQ gives up, this is gonna push lower. So I think I'm gonna put in an order below this. It's a good setup, new high, lower high, big picture is good. And I'm gonna put my stop above the highs. And I'm gonna manage accordingly. Nice failure there. Again, like the big thing is this could just come down and bottom and continue higher. So this point, just kind of let it do its thing. See how it plays out. Again, like this, looking, even on a 5-minute, that's a nice 5-minute candle. But we'll see what it does. 1x. That trade's done. Double 2. Now we're on to 4. I'm gonna go long here. If it breaks above this previous candlestick, I think just to go 1x here, it's a nice signal to hit just this swing high. We don't even have to go that high up and past that swing. I think that's totally reasonable of a move. Just gonna see how this plays out. Okay, we are in. Put my target. Again, I'm kind of nervous about this one. It just doesn't feel great. The setup's there. Big picture, we're at a nice level. We've had a massive move down. My inclination this morning with the market was gonna do a pullback and push higher. The ES is actually looking stronger. I would say it's pretty choppy at this point. I'm taking that trade at 8:30, which is kind of like not a great hour. But if this candlestick finishes forming like this on a 5-minute, this looks clean. Wait, I'm only in 4 contracts over here. No, that's so upsetting. Come on, just fill that. I need more contracts. Oh no. Okay, now our risk is better. Okay, as that is a little funky. Still legitimately doing this. We're gonna get out when it hits 400 in profit. I didn't even realize I was in less contracts. I was looking at it and I was like, well, I'm not up enough money for where it is based on the chart. So now it's fine. Now we just need it to go up. Normally, if I was just gonna get out at basically 1x, I would just get out right here because it's clearly showing some resistance and breaking through that previous swing where that weird news blip was right here. It had a random candle that just shot lower. Was just not worth it, essentially. But, I'm gonna let it play out. It looks solid. It's gonna hit me. So, I think it's gonna be basically at 400 too. 380, 407, 415, sick. Done with that. On to risking 800 a trade now, which is pretty close to my main size. Okay, so opening up the charts this morning, the ES futures look like they're trying to put in maybe a double top off of all-time highs. Not really in a spot where I like. NASDAQ has already pushed all-time highs. It's kind of holding this uptrend still. So kind of mixed signals there. So not something super great on that front. In terms of gold this morning, big sell-off into not really a great level. Overall, I think it looks like it's in more of a downtrend, like it wants to, continue down and somehow find a bounce down here eventually. With the market looking bullish, we could, in 5 minutes, a really nice sell-off, really overextended. I'd be worried it comes up here off of this kind of like bottom and just sells off. Not a ton of opportunities this morning, but you never know. I never try and just say, oh, I know what the market's gonna do and not watch it, right? You never know what it's gonna do. It's totally something good could set up. I am going to enter in $800 here, thinking that we're going to keep this momentum higher. I just entered in more contracts than I'd like for some reason, so we're a slightly larger size than 800. We are risking more like 1,000. Great. Well, mistakes happen. It's still a good spot. I want to see us push up from here. Now, granted, I could be a little early. Like, really, I should be waiting for this 5 minute to close because it could just come up here and show a little failure. And, maybe I then just FOMO'd into this. I'm going to try and close 5 contracts out here. Seeing as it's not the right amount. I shouldn't be in that many. I would like to be in the correct amount. Just kind of an oops, I would say. Okay, now we just sit on our hands and knees and wait for this to hopefully print money. Okay, let's see, while I painfully watch this trade, it's gonna bounce, I swear. Okay, gold all of a sudden is moving crazily. I don't know what that's from. That's a really nice sign for this trade. Maybe it'll just shoot up from here now. That would be sick. I would take that. Just reverse $800 on me. 5 minute, 5 minute looks good. That's a nice double bottom. 15 minute, honestly, it looks like it's good potential to keep going higher. We don't need it to go that much higher. It doesn't need to go that high for this. Oh, if it just rips up and then rips lower like that, that's gonna be an emotional roller coaster that I would have preferred to not be a part of. Come on, baby, break out. That's all I need you to do, just break out. If you break out, I'll give you a cookie. I have a cookie right here. Look, there's a cookie. I'll give you a cookie. Come on, you got it. There you go. There you go. Yep, that's what we want. Also, if you're wondering what trading platform I'm using, it's called NinjaTrader. I've used it for over 5 years. It's amazing. I'll leave a link in the description below this video if you want to check it out. That candle does not look good. That is not a good looking like action. Does not look good. 15 minute looks about the same. I'm gonna go walk outside. Come on! No, it was so close. No, don't tease me. It's so close. Come on, you got it, you got it, you got it. I still have that cookie for you. Come on, 5 minute looks great. Keep it going, my guy. Come on, yeah, there you go. Yes, oh, it's closing. Woo, close. Damn. That was crazy seeing the contract slowly close in like real time with that limit order. On to 1600. Okay, so I'm a bit behind this morning, but looking at, let's see, starting with oil, because this looks the best. It's kind of bouncing, had a massive sell-off yesterday, big sell-off this morning, continued kind of at this initial level. There's a bigger level down here, but kind of zooming in, it's definitely at a spot where we could get a bounce. Gold looks like it could be bouncing here too. It just had a spike lower here, and it's kind of coming into this, you know, overnight level. And then the market is big sell-off yesterday. So right now, both of these are kind of in the middle of their range. You know, looking at a 1 minute of NASDAQ and ES, they had, you know, a nice little spike in the open, but that, again, that's not really what I'm looking for. And maybe see if the NASDAQ and the ES make some kind of drastic move in some direction, like maybe come down here, set something up to look like to go long maybe. I'm gonna jump in here. I really hope I didn't miss it by not having my order in again. I would probably cry and go back to bed. Oh my God. Please fill me. Please pull back just a smidge and fill me. Oh, that's brutal. Should I just chase it there? I'm just trying to do too many things at once. And now if it pops up there, I'm like, do I even want to be in it? Oh, I could have literally just put my order here. It would have been filled. It literally one-ticked me. What does NASDAQ look like? I mean, that's a nice signal overall, you know? I mean, maybe I'm trying to just like be too tight with my entries right now. I don't know. I'm gonna put in a different order, see if I can get filled on it. I really don't want to chase. I think it looks good, but I don't want to chase up there. Come on, my guy, fill me. Even gold looks like it wants to bottom here. Just be patient. It's gonna come to you. It's really not that far. It's probably gonna come, pull back a lot. Come on. Try not to be tortured by this right now. If this breaks up without me, I'm definitely calling it a day. Just looking at these on like a 5 minute and the NASDAQ, they look good. Okay, we're filled. Okay, now just don't just puke lower on me now. That would just be rude. Yeah, there you go. Yeah, just get me. Oh, the torture of trading sometimes is just a little agonizing. So I'm actually based on the fill, I'm actually basically in 1900 over here. Man, if this just rips up and fills me for 2 grand right here, that would be sick. No, I don't want to move out to break even like that yet. Just gonna let it play out. I don't want to overmanage because I'm frustrated and all that. Just let it play out. The stop's in a good spot. Big picture, it looks great. I think I need a miracle at this point to save this trade, which sucks. It's happened before. Still in. Wish I went long gold. That's why we keep it below the low before it makes an actual breakout. I'm kind of surprised because this on a 5 minute looks pretty solid. And we haven't broken the 5-minute signal yet. We'll be breaking this low, so yeah, that's just kind of surprising. Feels way more like gambling and intense with this challenge of like not wanting to lose. Feels way more intense. And the fact that it's the last trade it pulled back on me in reverse. This trade, I'm not gonna say anything, I don't wanna jinx it. Oh my God. Yes, dude. Oh my God, that was the most painful thing ever. Oh my God, I really thought I was screwed on that one. Oh my God. Woohoo! Oh man, that was ridiculous. Oh my gosh, that was intense. So I've actually decided to stop this challenge right here. That last trade was pretty emotional. You saw how up and down it was. The whole idea with trading is to make money. Eventually I'd lose if I'm betting my account every time. Just to show you my results here, this took me pretty much 20 days, but I'm up a total of over $3,500. It's really important to know when to actually stop and reset, because otherwise you're gonna go on a massive win streak and blow it. If you've been trading for a while, you've probably felt stuck. Like no matter what you do, you keep running in circles. You put the work in, you watch the videos, you tweak your strategy, but somehow you're still not making consistent money. That's because almost every trader falls into two dangerous cycles. And if you don't break out of them, they're gonna continue draining your time, your money, and your confidence. And the first one is the learning loop, where you are stuck in research mode, constantly tweaking and never being consistent with one specific strategy. And the second one I call the self-sabotage loop, where you're now consistently executing a strategy, but you're making emotional mistakes that continuously wipe out your progress. These loops can keep you spinning for years, blowing up accounts, hesitating on good trades, and worst of all, wasting one thing you can't get back, your time. But once you understand these loops and how they work, you can break free from them. And I know this works because I've had students stuck in these exact same loops, and once they realized that, made a few key tweaks, they've been able to turn their trading around. Now let's get into the meat of this and go through how these two loops work and how you can break free from them. And first we're gonna start off with the most common loop that stops 95% of traders from even starting to become successful at trading, and I call it the learning loop, where you are just learning and tweaking your strategy so much that you never give yourself time to actually start practicing and becoming good at the strategy. The whole idea of how this loop works is, however you're learning content, probably through YouTube since you're here, is you find a new strategy and you start to learn new patterns. You learn my strategy and you start kind of practicing it. You test it out and it's not really working for you. You maybe have some success initially, in the first week or two, but over time, you're not getting those consistent results over the long term, right? And then from that point, logically, when you are learning anything in the world, it makes sense to go learn more, right? Because adding more information and learning more information usually makes you better at something. But when it comes to trading, there are infinite ways to actually trade the market. And so you are going to overload yourself with information. You actually don't need a lot of information to become successful at trading. I've always found that simpler is better. And so what most people do, and I did this myself, is I would say, this strategy just doesn't work, and let me go find a new one, or add, another indicator that helps confirm my trades that will increase my win rate. And in reality, that doesn't really work. You are essentially starting over from square one. Now, when you're starting out and you're learning new strategies, it's important to go learn a bunch of different strategies, because you don't know, what works with kind of your style and how you want to trade, and you're just starting to learn. But once you kind of do that, you got to really be aware that you are going to be stuck in this cycle really, really easily if you don't stop yourself from learning more and more strategies. And so how you break out of this is committing to one strategy. You know, over time, what I realized was simpler was better, and I came up with kind of essentially this 30-minute reversal strategy where I only trade 60 minutes a day roughly in the morning, and I look for one specific pattern. I used to try and think, oh, I can capture, you know, every move in the market. Anytime the market goes up, that's a missed opportunity. Every time it goes down, that's, you know, something I should have been able to read into a pattern and figure out that the market was going to do that, and I should have been able to capture that move and make profit off of that. But instead, what I've realized over time is executing the exact same strategy and looking for a specific pattern every day and waiting for that specific pattern is way more profitable because you are waiting for the market to fit you versus trying to fit the market. And that's reactionary, and that's not a profitable way to trade. And so for me, I literally look for, this is just a bunch of pictures of charts of trades that I've taken of saying, I just look for the same thing. The market opens for me at this time. I look to see if the market has a big, you know, move in one direction. And then I look for essentially a double bottom in the market, kind of 30 minutes after the S&P 500 opens. That's what I trade. I trade S&P 500 futures. 30 minutes after it opens, I've realized that that's kind of a timing where the market likes to reverse. And so if that lines up with the market doing a double bottom, that's a really good buy signal for me. And I just repeat that over and over. These are all different days where you can see the market opens, it spikes down, it makes essentially a double bottom. There's a nice big bullish candlestick. I buy above that big candlestick, and it fits that same pattern every day. And I wait for that same pattern. And if that pattern shows up, I take it. And if it doesn't, I just move on with the day. And it's able to be very, very repeatable and very simple. And this has helped me break out of that cycle of trying to constantly find new things, because you can see every day is slightly different. You know, sometimes the market spikes up and I look for a double top instead and bet the market's gonna go down. And some days it's just choppy and there's no good trade, or some days it's just sitting there and does nothing, or trends in one direction really fast and I get no trade. And that's okay. You don't need to be making money consistently every day to be a consistently profitable trader. No pattern or strategy is successful in every market condition. What you want to do is realize that, what can I be successful with? And then focus and narrow down on that. Start a trading journal and start tracking your trades and essentially mastering that one strategy. Because that's what's gonna break you out of this loop, because otherwise you're just starting from square one all the time and you're just gonna be stuck in that cycle. And I was stuck in that cycle for years and years. And I know a ton of my students are just the same. And you gotta remember, when it comes to what the trading journey looks like, with any strategy that you start out, you're gonna start out losing money or just not making any money at all. Even with a strategy that you could be profitable with in the future, you're not gonna make money with it right away. You're gonna be losing money because you're going to need to start mastering that strategy. And also, once you break out of that learning loop and start focusing and mastering one strategy, it doesn't mean you're just gonna magically start shifting your profit graph and you're gonna go up from there. Actually, what changes your chart to becoming consistently profitable and breaks you out of, you know, kind of slowly losing money and becoming consistently profitable with a strategy is you're then going to get stuck in what I call the self-sabotage loop. And that's because you are going to start executing and trying to consistently match your trades. Like, for example, if you're executing my strategy every day, you see this setup, but all of a sudden, you know, this happens and your strategy says, okay, I need to buy, but you get, you know, scared. And instead you don't take that setup and you miss out on a profitable trade. Or you jump in too early, like somewhere down here, and the market stops you out when it makes one more push down while it's making that double bottom. And you get stopped out when the market makes one more push down, confirming that double bottom. That's when you're starting to get FOMO. And so the self-sabotage loop comes from your emotions and you negatively impacting your ability to consistently, properly execute this strategy. What allows you to turn your profit graph to consistently making money is learning how to actually manage how your emotions negatively impact your trading. Everyone is slightly different. They have different emotions that will control their trading more. But the idea is, you have either greed that makes you, jump into a trade too early, take a loss, and that messes up how your strategy is actually supposed to work. Or you have fear of getting in a trade, and so you miss out on a profitable trade, affecting the results of how your trading strategy should actually work. And so you have to go in and think about what emotions am I feeling and how they are affecting my trading. How does the impulsivity that comes into me when I feel fear or nervousness, or I have FOMO, which is the fear of missing out of a potential trade, how do I react based on that? The whole thing with trading is you can feel all these emotions. I still feel all these emotions, but I don't let the emotions control me. That's the biggest thing when it comes to trading, is controlling your actions how you want. You don't have to be an emotionless robot to be successful at trading. It's actually the opposite. It's you need to feel all these emotions, but learn how to react properly to them. Change how you react to them. And instead of, revenge trading and taking, having massive blow up days or weeks where you jump in trades just based out of frustration, you instead stop yourself from doing that and say, hey, I need to just be done with trading for the day and move on, reset, and come back the next day and consistently wait for my pattern and strategy to show up. And so how you break out of this is you have to kind of figure out what your self-sabotage loop looks like. And so to walk you through what my self-sabotage loop is, so you can kind of see how it works, how it maybe, gives ideas to how yours works, and then we'll talk about how you can break out of it. And so how my self-sabotage loop worked was I always had a massive fear of being wrong with my trades. I was always scared that my trade would not work. That this one time that I'm getting in, the trade's not gonna work out. Even though trading it's like you're going to the casino, right? It's all percentage based. You're not gonna win every trade. Logically, I always knew, my win rate could be 50%, but I, make 3 times the amount that I lose. So every time, I lose a trade, let's say I lose $100, but every time I win a trade, I win $300. Well, at a 50% win rate, you're making consistent money over the long term. But when it comes down to trading, I would have kind of that narrow tunnel vision would come in. That fear would kind of make me just tunnel vision on this one trade. And the fear would overwhelm me and control my actions. And I would end up skipping the trade. And usually because, for me, most of the time when I showed up to trading, I was dialed in, focused, waiting for my strategy. And a lot of times my read would be pretty good. I would notice that pattern and it was a good trade. And so I would end up skipping a good trade, skipping out on, profits. I would then be frustrated because it was, it pissed me off that I missed a profitable trade and I really should have been in it. I knew I should have been in it. I just got a little scared, hesitated, and especially for me trading on, a smaller time frame like a 1 minute chart, things happen quickly. You have to take action right away. You can't kind of sit there on a higher time frame and kind of let the emotions kind of ease out a little bit and, jump in. A lot of times by the time, I get over that initial fear, the trade would be gone. The market would have already, shot up in the favor of that direction that I was thinking, and it would be too late. So then, I'm frustrated. I would continue to watch the charts because, I said, well, maybe another setup will show up, right? And so I would then FOMO or impulsively jump into a bad trade. It would start to set up, or it would, I'd cut a few corners, right? Like, let's say I have my 5-step entry checklist that I wait for every time. Well, instead, I get 4 out of 5. And I say, whatever, it's good enough. I just missed a trade. I gotta get in here. I'm not gonna miss another one. And so I would jump in, with FOMO, and that impulsivity would control me, and I'd jump in, and it would normally turn into a loss because, well, it's a trade I just shouldn't have been in anyway. And of course, then that loses. That's now 2 losses on the day, and I would then, be really frustrated. Sometimes it would be, worse than frustrated. There's going back to these, that there would be, some days it would turn into kind of hopelessness or desperation. If I'm kind of on a losing streak, it'd be just like, ugh, I keep doing this. I'm stuck in this cycle of constantly, blowing up my account or going on these losing streaks, and I can't seem to make things work, right? And then eventually after that, some days I would even revenge trade. I'd frustrate and take another loss. And eventually though, I would, be done for the day. I'd be like, okay, I have to be done. I gotta cut my losses. Things aren't working out. And I'd take a break, right? And I would essentially reset. Normally I'd, be done for the day, and I would reset, and it would come back as the next morning, and I'd be good to go. For me, I can reset over the night usually pretty well, feel refreshed and kind of focused again, ready to trade, and it would start that same loop over and over of that fear of being wrong. That a setup would come and I'd get nervous and I'd skip the trade. And so this was kind of that cycle that even though I had a good strategy, I would be stuck in, and it would stop me from becoming profitable. And so let's now talk about some actionable steps for you to break out of this self-sabotage loop. Now, the first thing is, through this video, you have already started to build your awareness. You need to go through your trading and start to just realize, okay, what are my emotions? What are they doing? Is it FOMO that is messing me up? Is it, nervousness? Is it greed? Go through and think about your trades and make a list of, what's damaging your trading. And then you need to go in and say, okay, how am I reacting to those emotions? How are they affecting my trading? And how am I trading when I, feel those emotions? Am I impulsively jumping into a trade, or am I stopping and not getting into a trade when I really should be? What you need to do is make a trading journal and start to track and build this list from your trading. Every time you take a trade, go in and write down your emotions of what you felt when you entered in on that trade, or what you felt when you were managing the trade. Did you get out too early of your trade because of fear? You didn't want to give up your profits, or you let the trade go on too long out of greed and you gave up way more than you should have because the trade came back against you. And initially, you kind of saw the market going up and you said, okay, I should probably get out here, but you kind of got money eyes and the euphoria were like, well, what if it just keeps going all the way up? Why would I want to get out here? But in reality, the trade, you saw the spot, maybe it was at a resistance zone up here, and instead it reversed right there, and you would have got out at the tippity top. And then the next stages of that is, from understanding these reactions and building your awareness, you'll start to realize, okay, well, how do I want to react based on that? Most of the time, it's, the good default is, well, I want to follow my plan. If my plan says to jump in on a trade here, I jump in no matter what I feel. If I'm scared, that's okay, I accept it, and I jump in on the trade. That's how you overcome, your emotions controlling you and impulsively, either jumping you in on a trade or getting out too soon. And then, of course, the last one is you start consistently reacting correctly. And what that kind of looks like is, here's your kind of normal cycle of, stuck in that fear of being wrong. For me, this was my cycle, right? Instead, I've created a new cycle, a better cycle that essentially helps me be profitable. And I will jump in the trades consistently. And essentially I'll see a setup, I'll be kind of nervous that it's maybe not going to work out. That fear of being wrong still comes up. Trading is still intense, even when you've done it for years and years, because you're always increasing that size. It's always intense still, right? And so instead though, I'll feel that emotion, accept it, and say, well, I want to follow my plan anyway, and I take the trade. And so I take the trade. Sometimes it doesn't work out, but a lot of the time I have shifted my mindset to say, well, me jumping in on a trade that sets up how I want, that's a good trade. It doesn't matter if it wins or loses. Instead, a successful trade for me is if it was a good trade setup. If I jumped in when I knew I should have, and when the patterns aligned with what I'm waiting for and looking for every day. And so from there, that helps me build confidence because I traded how I want to trade. If you're doing this and consistently executing through your emotions and you're still, not profitable, that just means you have to go back through your trading journal and tweak things. That's where, you really start to narrow down what's working and what isn't. A lot of the time, you will find that if you can take out a ton of the losing trades, or your ones that consistently lose, there's some common denominator of why. And if you take a lot of those out, and you can through, collecting that data and reviewing your journal, it'll drastically pump up your win rate and how much profit you're making consistently. And so from there, it makes that new cycle of, instead of, my muscle memory being to skip the trade, my now muscle memory and, kind of mental pattern is to take a trade. And I'm now essentially, you could say, stuck in a cycle that is positively impacting my trading versus one that's negatively impacting my trading. So really take the time to think about this and how it is affecting you and your trading, because it's really gonna help you become consistently profitable. So I'm jumping in along here. We've had a really nice flush lower in the opening 15 minutes, and big picture, we've had a big sell-off overnight. And so I think we might have essentially a fake lower here and then a rip higher potential. So this was a little too aggressive to get it on this candlestick, because it could just pop up here, recover this a little bit and then continue lower. But seeing it pull back here, essentially make a higher low, and then I got in on the break of this swing high here. So that essentially confirms it's making a higher low and starting to make higher highs as well. Pretty much the opening price is here. And so I don't think I'll go break even until it kind of comes up here to 2x. Big picture, it'd be sick. Just looking at a 5-minute and even to pull down a 15-minute, big picture here is, that we've been in a strong uptrend, and we had FOMC yesterday, lots of volatility, good potential to rip back up today. I don't know if I'll be able to hold through that whole move, which is totally fine. I would rather just capture the initial easy spike this morning, but I do want to try and be patient with this, because sometimes these flushes in the morning, it could pop up here, pull back, and then rip higher. And because today has such a high volatility chance, I want to give it some wiggle room. It's really easy and nice to try and go break even early, take that risk off the table so you're not scared and nervous about losing that money, or giving up your profits. But it's a lot better usually to just go with what the market is telling you. And I could totally see it come down here, retest this low, which is yesterday's huge swing low off of FOMC. And so as it rockets up here though, what I want to be looking at is, I'm not going to get out on a 3x here. I think maybe a 4 if it just spikes like that. But I do want to see how this initial pullback plays out. It's scary kind of risking giving back essentially all this profit and the loss here. But in reality, it's really unlikely it just spikes like that. This is a really good signal. NASDAQ is recovering as well. ES is stronger this morning, and that's why I went in on the ES. You could see based on just this pullback right here, these two candlesticks, if we compare that to these two candlesticks on NASDAQ, a lot weaker. And so I took the NASDAQ over that. And so as this goes kind of parabolic here, I like to get out if it breaks that, because it's hard because there is big potential today and a big picture to continue higher. But there's also these, I just want to mark these as minor reversal zones, which can cause a move that's this aggressive to turn around. So that's kind of what I'm seeing here today. I think at this point, because I've hit 2x, I'm gonna go break even. If it pulls all the way back here, I'm gonna get out. I don't want to risk a loss at that point. That's a nice little 1 candlestick pullback. This is a huge candlestick. And I don't want to get greedy here because this is kind of crazy movement. I just want to see where Forex is. We're at a spot where we are. I'm going to start. I'm pretty much having a mental stop at this point because this is just going crazy. And obviously I've been super patient the whole week. And this is, you know, my heart rate is spiking and I'm nervous and excited. I basically have to hold back here, hold a pullback here. I'm gonna close these out here, just knowing that it's hitting this is important. I want to give it a little more room here. I'm just trying to look at where a 50% pullback is. Okay, we've already done that, never mind. In terms of management, I mean, obviously I'm going to get out if it comes all the way down here. I would like to get out somewhere up here, obviously, if it's going to stop. But I also want to see it pull back here and push higher a bit more. In these uptrends, they can have little pullbacks like this. And so I want to give it room. It's not really at a big level to where I would expect a reversal. But once it spikes up one more time, I'm going to get out. I'm happy with that profit. I don't need to be going for $10,000 with how fast this is moving, because this could just rip lower on a dime here. I think if it starts to chop here 1 or 2 more candles, I'll pull my stop up here. But I would really love it if we broke higher and I hit 6K on a trade. That would be my biggest trade so far at this size. And obviously that would be a shitload of money. But, you know, you can't think about the money too much. You need to focus on what the market's telling you and following your strategy. And my strategy is try and hold with this uptrend until it tells me otherwise. And it's starting to slow down here. But it also looks like it could make one more break higher. Trying to be patient here, not let the nerves get me out here, because this is a huge strong candle and it's really just flagging out here. And if it spikes here and rips lower, then I'll get out as well. That's a good signal. I'm going to tighten up below this candlestick. And I think it's either going to continue to rip after that chop right there, or it's going to slow down. And I'm just going to leave my limit where it is. I'm totally happy getting out if it does that and rips lower. Of course, obviously, it was so close to getting my limit there, which sucks. But getting out right here is still a sick win. It's still 3x, really. Swaying, yeah, we're out. This is it. This is the month where I make a run at it. I am going to try to make $30,000 in 1 month trading by tripling my trading size. Once you can consistently make money with a smaller amount, all you need to do to make more money is increase your size. So that's what I'm gonna do this month. I'm gonna show you every trade I take, walk you through every part of the process, good or bad. Keep you updated on any changes I make and how adjusting to the new size increase affects me and my trading.
Order filled.
And then I'm just gonna have my target somewhere up here at the open. Yeah, at this point it doesn't look great just because the ES is just kind of continuing lower. I think if the ES was gonna bounce, it would have done it right here. Now risk reward wise, I think it's still just, you know, it was a decent looking trade, 50-50 kind of thing. And I think the 50-50 would have been a great, you know, risk reward, but knocked out. Looks like it's just gonna continue lower. So I lost over $5,000 this week. I've never lost that much money in trading before in 1 week. It's because I made a lot of dumb mistakes. I just sized up and I've realized when you size up, the money is a lot more intense, and so you're way more likely to revert back to some dumb mistakes you made. On Monday, I got in way too early. I didn't wait for a really good spike and flush lower, kind of a final fake out that I really find way more high probability. And I, you know, instead had some FOMO, thought, oh, what if I jump in right here and, or I don't jump in here and I wait for a better setup and I miss out on a trade. And, you know, now I'm thinking, well, you know, if I miss out on the trade, that's $3 or $4 or, you know, $5,000. That's a big key I need to not do. The second one is betting against really strong momentum. As a reversal trader, I'm always betting counter trend in a way, but I always try and make sure that the trend is clearly over and has high chance to be done and looking to reverse. But I've noticed over time is that when there's a really strong momentum move, that it doesn't reverse right away. A lot of the time it takes time for that momentum to work itself out. And so I know in those spots that it's better to just not take a trade there and know that it's less likely and less probable. And instead I jumped in and took the trade. The third one was betting against the big picture trend. Because it looks like it has momentum potential. Of course it could not, but the risk of waiting too long is just, it just goes without me. What is the trend over the past couple days, past couple weeks? And I took a trade in gold. It had a nice move up into a resistance level, but I thought going into that day that the major trend was to the upside. And so it was more likely that once it hits that resistance level, it's just gonna maybe slow down for a minute, but it's gonna continue higher. And I tunnel visioned, looked at, you know, the micro trend and thought, well, it looks like, you know, it's giving me some micro patterns and signals that it could reverse. It started to reverse, but really did a fake out to the downside and then shot higher again because that big picture trend came back into play once it had a pullback. And so those are three big lessons I need to use going into this week. I'm gonna make a piece of paper on my desk so I can tangibly focus on the key major mistakes I think I commonly make now, especially when the size is bigger. And so hopefully I can avoid those dumb mistakes and make some money going into this next week. But I like the potential to go lower
Order
here.
filled.
I'm just gonna enter in and then I can explain it in a second more. So big picture, the market is bullish. And so it's had this massive move up, but it's also hitting this trend line. And I want to see, I kind of need to see how it reacts to this previous high. Part of me feels like I'm going against my rules a little bit of really strong uptrend. Just trying to look at this, see if I want to move my stop down. I don't think yet. I think I want to move my stop down if it starts to punch down to here. Just because of my lack of confidence in the trade, my upsetness with myself or frustration of myself of kind of, I don't know, feeling like I broke my rules a little. Okay, well, small loss on that. Okay, so after breaking my rules for a couple days, I have written down on a sheet kind of what directions I think and trades I want for each market. I'm gonna get long. I'm a little nervous. ES is hitting highs. but I'm gonna get long here. Big picture is aligned. There is a nice bottoming pattern with a flush here. Downtrend into this area isn't crazy.
Order filled.
You know, initial target will definitely be the open, and we'll just kind of see how things get going here. Really gross. I'm gonna go long on this. The idea that it's basically faked lower, and it's gonna continue and break this and continue higher with the trend, and this is just a pullback. And instead of looking for a reversal here.
Order filled.
I'm gonna move my target up a bit more because I don't want to get knocked out on a spike. With just the idea that this market is very volatile. It has the potential.
Order filled.
Big picture on a 5-minute, I think it looks really good potential wise, but I'm also nervous that it's just doing a little retracement here. 50% of this move and then failing. I'm just gonna move to a 5-minute for now because it's just choppy, and I mean, it's either gonna knock me out or it doesn't, right? Yeah, I'm trying to, in some spots, since the market's been so trendy, is looking for some of these reversals to fail, where, you know, it has a strong uptrend, it hits a level, does a pullback, and starts to make some nice price action to go higher to continue that uptrend. This one, I don't know, I think I force this one a little bit. I think in better spots, the better signal is when it hits this level and starts to chop a little bit, versus this was chopping too long. And so it might just go into a chop fest. Pretty gross. So I'm down over 11K in the last 2 weeks, and I've never been down that much money before, and it feels emotional, and I, you know, feel like a failure, and I've kind of lost confidence in my ability to execute my trading strategy. It's not the strategy that's losing me money, it's the fact that every day I'm going in focusing on the money and not focusing on the process and not focusing on being patient of when to take a trade that aligns up with my strategy versus, there's a potential trade here and jumping in on it, and I'm not getting in when I need to be, right? And so I'm trading very emotionally and all over the place. And so what I'm trying to do now is recenter myself, because the market is always going to be there, and I don't need to take trades every day to be successful, especially at the size now. That's what has really kind of made me go a little crazy, I think, is that the size is so big now that I can take one trade and make, 5K from it. Or if I size up a little, it could be like 10K, and that's kind of mind-blowing. And so dealing with that has made me need to realize I need to, focus on the process and go into every day not caring about if I take a trade that day and if I make money or not. The focus needs to be on a good, successful trading day needs to be if I go in and take a trade that is based on my strategy, not if I go in and make money or lose money. And so that's what I want to do going into this next week. And going into the next couple weeks, I don't want to frame it as, even for this video, oh, it's a success if I can dig myself out of this hole. That could take longer. You know, doesn't depending on what happens with my trading and the market, right? And so a win needs to be if I go in and take trades that I want and take trades that I like versus jumping in on trades and making money. Because that's, again, going to keep me in that emotional driven state of FOMOing, of being nervous, being scared, and tunnel visioning, and just continuing to lose money. With that being said, hopefully the comeback starts now and I can focus up this week and just take a couple of trades when they come along and focus on being patient, because that's what's going to make me money in the long run. Okay, let's get this train rolling. It is a fresh week. I am going into this week with the idea of I'm trying to just execute my strategy how I see fit and be super patient. A win is, getting my trade and strategy when it shows up versus trying to take trades and make money in the market. The ES and the NASDAQ are not aligned, which doesn't look good for trading, either of them. Usually I like to have them kind of be move in the same direction because it's more likely that they do something. Took a quick break, but ES is just choppy. NASDAQ had a little spike at the open, but it's still just choppy. I'm just going to call it a day. Totally happy with that. No need to push it when there's really nothing going on. It's made a nice higher low off of this area I've looked for. It's a double bottom, head and shoulders, off of this previous high here. Nice bounce there, and then a bounce here. So that's pretty dang good structure. The only thing is I feel like my intuition is kind of saying that this is, it's already had two big moves for the day.
Order filled.
And I'm just nervous about this gold trade just because it is a little later than I normally take a trade, and it feels like could just be getting choppy. But also I'm just nervous because I'm scared about the outcome. What if it loses here? But again, the reasons to get in were solid, and that's what I want to be focusing on, right? It's not about the trade outcome, it's about the process of executing when it follows your strategy and pushing through that nervousness and emotion. That could be a break of this trend. Now, I need to see a couple candlesticks and see what it does. But I think at this point, I'll move my stop loss up to here at least. I would really be kind of upset to get out here. Getting out here still, I was happy with how I traded. I think I stayed in it. Getting it out somewhere up here would have just been, I think, kind of, I don't know, more emotional, and just because the trend was still in play. There was no reason to get out based on the charts until now. So still a nice trade. Nice to get something in the books, but bummer that, to get knocked out here, because part of me is like, oh, it looks like it could just knock out and then reverse, but that's the signal I'm going with, and I'm gonna call it a day on that. Gold is potentially getting that pullback I'd like. I actually think I would get long here on this, as it's come up and it's done a 50% pullback. It's gone past that actually, and if it pulls back and breaks higher, I think that's it's just a really good sweep lower. It's kind of nerve-wracking getting in on this volatility a little bit.
Order filled.
But I like it to the long side. Okay, definitely some whipsaws here on gold. That's kind of spooky, but held through the pullback I want, and that's what I'm looking for. Dang, so I had a break even, or not a break even, a loss on that. I really thought that pullback was gonna look good. 7 contracts, holy shit, I almost accidentally did 7. That would have been not a good time.
Filled.
I like this on a 5-minute. Just using the 1 minute as an entry signal, and a 5-minute looks really good. But again, I'm not gonna touch it. I don't wanna get out just because I'm scared. You know, the big picture is a nice signal. We could pull up a little bit more, make a new high on the ES, and then start to sell off. Okay, out on that trade. So this is the end of week 3, and I am still really in the hole. But going through this process, I've realized, and you know, kind of after week 2, when I was in that emotional spiral, and this week I feel like I've started to right the ship. Maybe not in results yet, but I've started to refocus on the important parts of trading. And this week I've done a lot better job of refocusing and saying, you know, taking stuff away and saying, okay, it doesn't matter about the results. I have to focus on the process, taking away trading gold and oil and saying, okay, I know I can be good at focusing on just those morning reversals and just trading those, and being patient and not forcing trades, not FOMOing, not feeling like I have to make this money back because I am in such a hole. And so next week I have to go into the week, focus on the process, because that's what actually makes money trading, and be disciplined in my execution. Because right now having an 8% win rate is really not reflective of, I think, my strategy and my ability. It's me being in this emotional death spiral. You know, it's a part of trading of adjusting and putting all this pressure on myself, but I have to adjust quickly because otherwise I'm gonna lose a lot of money, and I'll come out of it on the other side, hopefully being a better trader and being able to make more money. And so I, don't really know if I'll take much of a trade today. I don't plan on trading very long because I, had my 50K ultra marathon over the weekend. I am completely exhausted. Yeah! Let's go! Trading a long time today is not going to be a smart thing because I won't make good decisions. I'm sitting in my chair right now. I pretty much always stand when I'm trading. Standing on my legs right now just doesn't work very well. So I wanted to show up to the markets today and kind of see what was going on. Take a trade if it sets up really perfectly. But if it's kind of in that middle ground where we are right now, where it's like middle of the range, not a high probability level. There's just no point in forcing things. There's no really strong read, and so I'm just gonna call it. There's no reason to try and force anything. I think that's a good enough signal there for me. And again, with the NASDAQ having the ability to really spike higher here, I'm gonna jump in. Nice confirmation on the ES so far. Still hasn't confirmed that it's broken that, but I'm just gonna let this play out. I like the entry. It's following my timing, my strategy, head and shoulders here. And I was waiting till both kind of aligned. Just nervous, especially with this still, I don't know, kind of selling off here at this downtrend. Ideally, I should really have my stop below here. Knocks me out there. But I mean, I figured that, hey, it's either gonna go up or it's gonna fail here. I think I made some good discipline moves this week in terms of jumping off when I wasn't, sure, and essentially just getting more aligned with how I should be trading my strategy. And that's the whole goal of trading. For me, going through adjusting to this big size. Now, I haven't really got a win yet, which is really frustrating and rough. Which causes me to feel like I'm going to fall back into that emotional spiral. But trying to limit that and stay on the right side of things, and being patient and knowing that it will come, and that I don't need to adjust my strategy. The market's been tricky right now in terms of making huge moves and that triggering FOMO. I mean, it was a tough trading week, and I only took one loss, so that's a huge improvement on what was happening before. I'm going to trade next week and hopefully come into next week and, you know, at the end of the day, like I am 2 wins away from being break even. That's what I have to remember. I don't need that many trades to make a lot of money with this strategy. Okay, coming into today, I've taken a few days off from trading, and so it helps me to get back into the swing of things by visualizing what I want to do, reminding myself how my strategy works and what I'm looking for. You know, what is that repeatable thing that I'm looking for every day versus just kind of showing up and being like, okay, I'm just going to trade. Market hasn't opened yet. Got 7:30 my time is when it opens, and then other couple windows I like, 7:45 and 8. These are my two spots where I want to see it come down in reverse. If it's, you know, either way at those timings, that's kind of lines up with what is repeatable for me versus I find, you know, going into the market and just trying to enter in randomly just does not work very well. So what I would like for a long here, now that it's broken the lows, I would want a head and shoulders to go long here. Because otherwise, it's way more likely that we just, especially for the NASDAQ here, is come up here, test this, and just continue lower. Because we're not really bouncing off of a support level. Now, we could just be doing a failed breakout of the overnight lows here. But big picture, we could just be in a downtrend that's going to continue lower, you know? I like this to the upside. I really want to see, I'm nervous that I'm just going to,
Order filled.
it's just going to pump me in and then rip lower, but I think I'm just going to get in long through that nervousness because it's made a nice head and shoulders there. I'm going to just put my stop down here. Spiking all the way back up here, I'm going to go to break even. I want to just see where we're at here, but a lot of the times recently I feel like it's hit the open and then slowed down, and so getting out at just 2x has been really good to do. I'll see how we hit 2x, I think, and then I think maybe I'll go previous candlestick with the trailing stop. If this also reverses here, I'll probably move my stop up here as well. I definitely, if this starts popping up here, I'm going to move trailing stop. Like really tight here now. Like up to 2x. NASDAQ is popping as well. For me, mentally, I feel like getting 5K on the trade is kind of a mental number I really want right now. It's not good, but that's just the reality. But I also don't want to just let that control what I'm doing. I want to run a trailing stop here if this is just going to continue to pop. I don't think that's over greed. I'm just going to put it trailing stop here right at the bottom of this candle. Because I think either it's going to keep going up or it's going to knock me out. And if it knocks me out here at 4,700, I'm totally happy with that. Come on, hold and keep going. That's okay. I'm totally happy with that. But 6 start to the day, 6 start to the week, that is exactly what I want to be doing in the mornings, and that's my repeatable setup right there. You know, get the emotions of managing it and dealing with this. If I wasn't as triggered by the money right now, I would have held through this and let it do a 50% pullback and let it go higher. But all things considered, I waited for that setup. This is exactly what I wanted, and that's what I want to be doing with my trading. That's what's repeatable, and that's how I will be consistently profitable. So we're coming down to the support zone on the NASDAQ. We've had a nice pullback, and we're coming into this 15-minute reversal timing. So normally I'd be looking for, you know, potential long here. The problem is, if we look at the ES, it's just chopping here. It's just opened up and really done nothing. And I have been trying to drill into my head, if they're not aligned, I don't take a trade. Okay, so NASDAQ and ES are just sitting here chopping. We just opened and chopped. It didn't really do what I was looking for. We're coming up on 8 o'clock, you know, the 30-minute window. The 15-minute window right here didn't really make sense. It just kind of sitting here chopping. And again, I want to be going into every day looking for the 15 or 30-minute reversal. And if it doesn't show up, just call it. Just move on. Don't get sucked in of trying to capture a win today. If it doesn't show up, it doesn't show up. There's no point in trying to stay and figure this out because it could just chop here forever. I'm sure it eventually goes some direction, but is that tradable? And is that consistently tradable for me to repeat over and over? And in my experience, for me, no. And so I'm just gonna call it and move on to the next day. The last 5 weeks have been a roller coaster for me. I think now the last 2 weeks have been way more focused and exactly how I want to trade and how I know how to be profitable trading. And the first 2 weeks, if you look at, kind of just go back in the video and look at how emotional I was, how focused on the results I was, and how I was kind of in just this emotional death spiral. When you look at my results, was destroying my trading. And I think that's exactly what happens to every trader when they get way too focused on the results or the money gets too big and you just get in that tunnel vision. I really had that for the first 2 weeks, and having to reset myself and find a bottom and essentially rewrite the ship so I didn't start to burn tens of thousands of dollars now at my new size. And doing that while trying to film it all and everything it made it it added to the intensity. And so that's something I wasn't used to, and adjusting to that took a couple weeks. And now going forwards, over these last 2 weeks, I can really see, looking back, is my focus has got to the right mindset and the right way I want to be thinking about trading, and the right way any successful trader should think about trading. Because at the end of the day, it's about doing what I personally can consistently and profitably do and repeat every single day. What I was trying to do in the first 2 weeks was jump in and try and just read the market in real time and capture every move that the day has, even if it's in my morning window. And I can't consistently do that at the end of the day. And it makes it too intense for me. So now shifting back and regaining that focus of, I actually know what I can be consistent with, and it's just waiting for that 15-minute and that 30-minute reversal timing, and waiting for the markets to be aligned together. And if I'm really confident in my read, then I take a trade. But if it's kind of back and forth, just close out. There's no reason to force a trade. I have the luxury of being patient and just saying, hey, I'm just gonna move on with the day. Even if, I stayed another 10 minutes and maybe I caught a trade, it's just not worth it. Just wait for, I could take 4 trades a month. And if I make, 4 or 5K from just those 4 trades being wins, that's 20K a month. Next time I size up, it gets bigger and bigger. So that's what I want to focus on going forwards in my trading, because that is how I'm going to be consistently profitable trading with this new size over time. So now the next best thing you can do is make sure to get that 90-day roadmap via this QR code or in the description below. It will have a great step-by-step list for what you should be doing and focusing on over the next 90 days. Plus, you'll get an email 24 hours after that with all of my other detailed free PDF guides, like favorite candlestick patterns, 75 trading lessons I wish I knew sooner, and so much more. Also, make sure to check out NinjaTrader if you need a trading platform. It's such a powerful platform, but also simple, which is extremely important for executing trades.